So hi everyone, a very good morning, good afternoon, good evening or good night at whatever time you're watching. So this is CA Tofik Tufail and we are coming up with something very exciting, and this is, when I was studying there was no one who was doing such thing. So I thought that let me do it for my students. So in this video I have picked the most comprehensive problems where if you only solve that problems, all the concepts have been covered. So this is sure short 30 marks video. Spend some, so this will be around 3.5 to 4 hours. So spend some 4 hours. You see this video. We will be solving the question line by line of how we will be solving in the examination, and I will be giving you lots of tips and tricks in this problem, okay, in this problem revision. So I will be solving 11 problems, and in this 11 problems all the questions have been covered, okay, all the questions have been covered in terms of the concepts. So I have covered the investment decision, which is the section A. So if you go to section A, we have covered this part, okay, we have covered this part, and this part is covered in this video. So what are you waiting for? Watch this video, and what I am expecting is that if you like this video and if you feel that this video was a value addition for you, just give a like, because the YouTube algorithm works in such way that if you like the video, it will be recommended to other people of your circle. So let this video be shared with everyone, and all the very best for the coming examination. See you all, and I will be coming up with more concepts and more videos in the next coming days, and a lot of things you are going to see. So stay tuned, and thank you very much. Enjoy the revision. First problem, but directly I will not jump into the problem. First I will do a little bit of quick revision. Okay, sir, what is investment decision? How to take decisions? Sir, how to take decisions? We have non-discounting techniques and discounting techniques. So payback period, payback reciprocal, accounting rate of return are non-discounting techniques. And discounted payback period, net present value, profitability ratio, profitability index, it is also called as benefit cost ratio, adjusted NPV, internal rate of return, and MIRR, MNPV. What is MIRR? Modified IRR and modified NPV. These are the techniques through which we have to take a decision. Sir, what is payback period? When will I get my money back? The time taken to recover the investment is called as payback period. Sir, a payback period na, if it is annual cash flows, how do we calculate? Initial cash flow divided by annual cash flow. Okay, so which means 30,000 rupees I'm receiving every year. And what is my investment? 1,20,000 rupees is my investment. Okay, 1,20,000 rupees is my investment. 30,000 I'm receiving in the first year, 30,000 I'm receiving in the second year, 30,000 I'm receiving in the third year, and 30,000 I'm receiving in the fourth year. So total of fourth year is coming to 1,20,000. So in 4 years I'm recovering 1,20,000 rupees. Therefore my payback period is 4 years. Sir, what if it is not annual cash flows? Sir, every year I'm receiving different cash flows. Same thing, what you have to do, just cumulate. So this is what is the format per year, cash flow, and cumulative cash flow. So 20, then 20 plus 30, 50, 50 plus 40, 90, 90 plus 50, 140, 140 plus 60, 2 lakh rupees. Sir, cumulative cash flow you just know. Sir, how much is my investment, sir? 1,20,000 rupees in my investment. Now see when I'm recovering 1,20,000 rupees. Sir, third year end I recovered 90,000. Fourth year end I recovered 1,40,000. So which means I know that it is somewhere between 3 and 4. It is somewhere between 3 and 4. Sir, which means what is my payback period, sir? 3 plus, till third year I recovered 90,000. How much I want to recover? 1,20,000 rupees. Sir, which means how much I am falling short? 90 I have recovered. I want to recover 1,20,000. So which means 30,000 I am falling short. Correct? 30,000 I am falling short. And fourth year, how much I totally recovered? 50,000. So out of this 50,000, I want only 30,000. Understanding? So that is the reason I'm doing a proportionate. So 3 plus 30 divided by 50. That is what is the logic. Are you all with me? There is no formula for that. Okay, sir. So 3 plus 30 divided by 50, which is coming to 3.6 years. So my payback period is 3.6 years. Sometimes we also have to write it in years. Sir, 3.6 years. You have to convert this into months also. Okay, sometimes in the MCQ they will ask, okay, you will not find 3.6 years. In the MCQ it will be 3 years 5 months, 3 years 6 months, 3 years 7 months, 3 years 8 months, and how you have to choose? Sir, which means you have to convert this year into month. How should I convert, sir? 3 years na 3 years ba, okay ba? Sir, 12.6, How should I do, sir? 0.6 years na. In 1 year, 12 months are there. Up 0.6 years, how much months are there? So 0.6 into 12. Okay, 0.6 into 12. So 0.6 into 12 comes to 7.2 months. So approximately I'm taking 7 months. Otherwise, in the 0.2 also you convert it into days, but not required in my opinion. Okay, they will not do such a childish things in the examination. So 3 years and 7 months. So this is what is the payback period. Sir, what is payback reciprocal? 1 divided by payback period. Nothing great. Okay, approximate return. Sir, what is accounting rate of return? Sir, average return divided by average investment. Nothing but return on capital employed. Okay, so ARR is average return divided by average investment. Sir, what is discounted payback period? See here, time value of money concept is not considered. All different year cash flows are getting added. How can you add different year cash flows? So you have to first convert it into present value and then you have to add. Sir, here what is happening? Here the cash flows are converted into discounted cash flow, which is nothing but present value, and that discounted cash flow you're cumulative to finding out the discounted payback period. Sir, what is the step, sir? Year cash flow, present value factor at the rate 10%, at the rate discounting rate. In this question, I'm assuming discounting rate is 10%, then discount it to discounted cash flow, and then you will get the cumulative cash flow. Sir, from this cumulative cash flow, you have to see when I'm recovering 1,20,000. Sir, 1,20,000 I'm recovering between 4th and 5th year. So 3 plus, actually I've recovered 1,07,150. How much I'm falling short? I'm falling short 12,850. And how much I have recovered? 37,260 in the 5th year. So 37,260 and 12,860, I'm getting 4.34 years. So 4.34 years converted into months, it is coming to 4 years and 4 months. So this is what is discounted payback period. Quickly I'm jumping, we don't have much time to very detailed revision and all, but you know, for a start I'm just giving you. Sir, net present value, discounted cash inflow minus discounted cash outflow. Sir, what, sir? Total discounted cash inflow you do, which is nothing but other 144,410, then minus 1,20,000. I am getting an NPV of 24,410. Positive accept, negative reject. Okay. But sir, now again you see NPV considers the absolute cash flow. Sir, what is NPV? Discounted cash inflow minus discounted cash outflow. Project A is having discounted cash inflows 1 lakh and discounted cash outflow of 95,000. So that is my NPV is 50,000 rupees. Okay, my NPV is 50,000 rupees. Sir, project B, okay sir, project B, my discounted cash inflow is 10,000, my discounted cash outflow is 9,000, so my NPV is 1,000. Sir, 5,000 is more or 1,000 is more? 5,000 is more, you will select 5,000. But no, NPV only talks about the absolute value. You have to see the value with relation to the investment, sir, which means what, sir? I have to calculate something called as profitability index. Sir, what is profitability index? Ide same thing, okay, 1,95,000. NPV is 5,000, you will select project A, but project A is not correct. You have to calculate something called as profitability index. Sir, what is profitability index? Discounted cash inflow by discounted cash outflow, which is coming to 1.05, and here which is coming to 1.11. What is the meaning, sir? 1 rupee invested is giving me a discounted cash inflow of 1.05, and project B, 1 rupee invested is giving me a discounted cash inflow of 1.11. So definitely project B is better. Okay, sir, a discounted cash inflow minus discounted cash outflow is equal to NPV, and discounted cash inflow divided by discounted cash outflow is equal to profitability index. Okay, so quickly, sir, what is IRR, sir? The rate at which my NPV is becoming 0. Upper what, sir? See, 10% NPV you calculated. I want one positive NPV and one negative NPV. So you have to guess, sir, when you are increasing the discounting rate, your discounted cash flow comes lower. So when the discount rate is increasing, your NPV will be coming down. About 10% my NPV is 24,410. So what I have to do? I also have to calculate something for 20%. Sir, you're guessing, I'm just a guessing rate. Okay, 20%, I'm just guessing. About 20%, I'm getting how much? 11,140 negative. I'm telling you two methods to calculate IRR. One is the conceptual method. Sir, what is a conceptual method? Sir, at 10% discounting rate, my NPV is 24,410. At 20% discounting rate, my NPV is negative 11,140. What is IRR, sir? IRR is the rate at which my NPV is becoming 0. I want 0 NPV. At 0 NPV, what is the rate? Clarity. At 0 NPV, what is the rate? So now what I'm doing here is that if I am increasing my discounting rate by 10%, see, 10% is becoming 20% rate. So which means if I am increasing my discounting rate by 10%, my NPV is falling to 35,510. Sir, how it is falling, sir? 24,410 first becoming 0. So 24,410 fall, then one more 11,140 it is falling. You know, it is becoming negative, right? So 24,000 minus 11,140. So minus and minus is becoming plus. Understanding, right? So 24,410, if you are minus 35,550, you will get minus negative 140. Sir, if I am increasing my discounting rate by 10%, my NPV is falling by 35,550. How much increase I want to get my NPV as 0? When will I get my NPV as 0? If my NPV is falling by 24,410. Because if my NPV fall by 24,410, it will come to 0. Sir, which means if 10% increase is reducing my NPV by 35,550, how much percentage increase will reduce my NPV by 24,410? Sir, 1 mango 10 rupees, 2 mango how much? That is what they are asking. Sir, 1 mango 10 rupees, in 50 rupees how much mango I will get? Clarity irka? Nothing but cross multiplication. Cross multiplication. Sir, which means what, sir? Percentage increase is equal to 24,410 into 10 divided by 35,550. I am getting 6.87. I am getting 6.87. Sir, what does this mean, sir? Which means if I will increase my discounting rate by 6.87, my NPV will be 0. What is my IRR, sir? 10 plus 6.87. Clarity. So my IRR is equal to 16.87%. How many of you are understanding conceptual way of calculating the IRR? Okay, so 16.87 is the IRR. Sir, what is the formula method, sir? You have a formula. Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. This is what is the formula. Sir, how this formula is coming? Nothing but this formula is coming from here only. How you are calculating? 10. 10 is nothing but lower rate. Plus. Sir, plus what, sir? NPV at lower rate. What is 24,410? NPV at lower rate. Sir, divided by NPV at lower rate minus NPV at higher rate. That is what? NPV at lower rate minus. So minus and minus is becoming plus. So minus NPV at lower rate. Sir, into 10. What is 10, sir? Higher rate minus lower rate. There, without knowing the formula, we solved. Here, with knowing the formula, also showing you logic of how the formula is derived. Okay. See, this is not a concept revision, question revision, but investment decision is a little bit lengthy chapter. Lot of concepts are involved. So I thought, why not first teach you concepts in a very concise way. So that is how we have to calculate IRR. So once you put on the formula, you will calculate the IRR as 16.87. Same thing only you will get. Okay, same thing only you will get. So this is the concept of MIRR. MIRR means the same intermediary cash flows that you are having, right? You have to reinvest it at rate. You have to reinvest. You know, in IRR there is an assumption. So we will just see this MIRR concept once we come to the problem. So till now you have understood the concepts. Now let us jump on to the problems. Okay. One by one we will be solving the problem. Sir, let us read. Always reading the problem is more important than solving it. Sir, now an oil company proposes to install a pipeline for transport of crude from wells to refinery. Investments and operating cost of the pipeline vary for different sizes of pipeline. So different sizes, different diameters of pipeline. Okay, just one more. Different diameters of pipeline. Okay. The following details have been conducted. So if I am purchasing a pipeline of 3 inches diameter, what is the investment and what is the gross annual savings in operating cost before depreciation? So this is nothing but savings before depreciation. So if tax rate is given, okay, if tax rate is given, then I will also get some tax shield on depreciation. Okay. So if I'm investing in 3 inches, my investment is 16. If I'm investing in 4, my investment is increasing. So likewise, so as and when I'm increasing, so as and when the size of the pipe increases, my savings in annual cost is also increasing, right? So this is what is the savings. So more investment, more savings. But now I want to just choose which pipeline I should choose. So wherever my NPV is positive or whatever they're asking, the estimated life of the installation is 10 years. The oil company's tax rate is 50%. So whenever tax rate is given, Estimated life is given, a depreciation you have to calculate. Whenever depreciation tax rate is given, you always have to understand it is nothing but cash flow minus depreciation, PAT, okay. Gross annual savings in operating cost before depreciation. So minus depreciation minus tax and then plus depreciation, that will come to cash flow after taxes. There is no salvage value and the straight line method of depreciation is followed. Calculate net savings after tax and cash flow generation. Okay, so net savings after tax and cash flow generation. So basically they're asking you to calculate the cash flow after taxes. Cash flow after taxes. And recommend therefrom the largest pipeline to be installed if the company desires a 15% post-tax return. But what is this 15%, sir? It is the discounting rate. What is discounting rate, sir? Either it is cost of capital or it is expected rate of return. Also indicate which pipeline will have the shortest payback. Okay, which pipeline will have the shortest payback. So you have to calculate payback period, and wherever the payback period is lesser, that you have to select. The annuity PV factor at 10% for 10 years is 5.019. So present value annuity factor for 15% for 10 years is equal to 5.019. It is actually given in the question. Okay, so the question is completed. Sir, what they are asking? First they are asking, sir, which one I should install if the company desires 15% post-tax return, which means NPV you have to calculate. Okay, NPV you have to calculate. What is NPV? Is a discounted cash inflows minus discounted cash outflows. And also indicate which pipeline will have the shortest payback, the annuity PV factor at 15% for 10 years. Are you all having this clarity? Reading the question is done. So basically you have to find out NPV for 3, 4, 5, 6, 7. It is nothing but different type of investment. Okay, investment 1, 2, 3, 4, 5. 5 different investments are given. So for you have to calculate 5 different NPV. Wherever the NPV is higher, that project you have to select. Second, they're asking what is the payback period. Are you all ready? Let us solve this problem. Okay, let us solve this problem. Sir, first one. Okay, solution to question number 1. In examination, how we will present, likewise only I'm doing this. So because you guys are writing the examination, so you should have a feel of how you have to present it in the examination. Okay, sir. Now let us see the question. So first I will draw columns. Okay, first I will draw columns for 3, 4, 5, 6, 7. So pipeline diameter. Okay, pipeline diameter. Three, 4, 5, okay, 6, and then 7. Okay, sir, super. Now, sir, first one, gross annual savings in so first let us calculate the cash flow after taxes. Okay, let us calculate the cash flow after taxes. Sir, how to calculate cash flow after taxes? First, what is the gross annual savings? Okay, so before depreciation. So savings before depreciation, how much? 1624. Okay, so let me just start. How much? It is 1624. Okay, 16, 24, 36, 64 and 150. Okay, 64 and then 150. Sir, what I have to do? I have to do minus depreciation. So this becomes profit before taxes. then minus taxes at the rate 50 percentage, this becomes profit after taxes. I have to add back depreciation, so I will get cash flow after taxes. This much clarity you are having. This is what you have to calculate. Sir, what is the depreciation, sir? Okay, what is the depreciation? So depreciation is nothing but scrap value is 0, correct? So divided by 10, investment divided by 10. So 16 divided by 10, 1.6. So everywhere you just have to do divided by 10. That is what is the depreciation. Okay. So upper what, sir? This is 1.6. Sir, why 1.6? 16 is the investment and divided by 10 years. Okay. And salvage value is 0. So 16 minus 0 by 10. So this is what is the depreciation. Minus 2.4, minus 3.6, minus 6.4 and minus 15. Sir, what is 16 minus 1.6? Okay, take out your calculators. I also want you to solve. Okay, sir, what is 16 minus 1.6? Hey, wait. Really sorry, I have to take 5, 8, 15, 30 and 50. Savings is not 16. This is not the savings. Savings is 5, 8, 15, 30, 50. Okay, 5, 8, 15, 30 and then 50. Sir, what is 5 minus 1.6? 5 minus 1.6 is 3.4. 8 minus 2.4, 5.6. 15 minus 3.6, 11.4. 30 minus 6.4, 23.6. And then 50 minus 15 is 35. See, there is also one more way. From savings before depreciation, what you have to do, you just have to do after tax and then you have to add back the tax shield on depreciation. That is one more way of doing. Okay, one more way of doing. Directly reduce taxes. Instead of minusing depreciation, directly reduce taxes and then add back tax shield on depreciation. That is also one more way of doing. Sir, up now, this is what is my profit before taxes. So now I have to reduce the taxes. Okay, reduce the taxes. So 3.4 divided by 3.4 into 50 percentage. How much, sir? It is 1.7. Okay, it is 1.7. So here this will become 2. Okay, 5.6. It has become 5.6. 5.6 will become 2.8. So this will become 5.7. Okay, 23.6. It is becoming 11.8 and then 35 is becoming 17.5. Tax rate is 50 percentage, right? Tax rate is 50 percentage. Okay, tax rate is 50 percentage. Now, sir, next one, PAT, sir. What is my PAT? My PAT is 50 percentage, right? So this is 1.7, 2.8, 5.7, 11.8 and then 17.5. Add back depreciation. 1.6, 2.4, 3.6, 6.4 and then 15, which means what is my cash flow after taxes? Okay, what is my cash flow after taxes? So 1.7 plus 1.6 is how much? 3.3. Okay, so 3.3. You add here, you will get 5.2. You add here, you will get 9.3. Correct? 5.7 plus 3.6 is equal to 9.3. 11.8 plus 6.4 is equal to 18.2 and this becomes 32.5. Clarity. First part of the question that they were asking is calculate the cash flow after taxes. Okay, so calculate the net savings after tax and cash flow generation. Now next one, and recommend the largest pipeline to be installed if the company desires a 15% post-tax return. So this is my yearly cash flows. Okay, this is my yearly cash flows. Are you all with me? Upper sir, what I have to do? This cash flow after taxes, if I multiply it with present value annuity factor, if I multiply my cash flow after taxes with present value annuity factor, I will get discounted cash inflows. Okay, I will get discounted cash inflows, which is what, sir? This cash flow after taxes, I have to multiply it with what? I have to multiply it with 5.019. So 5.019 multiply. Sir, calculated trick. One number, when you have to multiply it with multiple numbers, type that one number first, 5.019. Okay, then you just do, okay, 5.019 into 3.3. Okay, into 3.3. So this is nothing but discounted cash inflow, which is nothing but cash flow after taxes into present value annuity factor. Okay, so which is nothing but cash flow after taxes into 5.019. So how much I'm getting? 16.56. Sir, 5.2 equal to 26.1. Okay, 26.1. Are you all with me? 26.1. Okay, or let me make it 3 digits. Let this be. Then 9.3, 46.68, 46.68, 18.2, 91.35, 91.35, and then to 32.5, it is becoming 163.12. Okay, 163.12. So this is what is discounted cash inflow. Now with the discounted cash inflow, if you minus discounted cash outflow, you will get something called as net present value. Okay, net present value. Sir, what is my discounted cash outflow, which is nothing but investment? Now 16, 24, 36, 64 I have to minus. Okay, 16, 24, all this I have to minus. So now what is this? 16, 24, 36, 64, and then 150. Sir, now if I minus this, sir, what is 16.56 minus 16? It is 0.56. Sir, 26.1 minus 1, it is, okay, 26.1 minus 24, it is 2.1. Sir, 46.68 minus 36, it is 10.68. Sir, 91.35 minus 64, it is 27.35, and then 163.12 minus 150, you are getting 13.12. Okay, you are getting 13.12, which means, sir, which pipeline is giving you the highest NPV? This, sir, what is this? Upper 6 centimeter. Okay, sorry, 6 inches pipeline. Okay, so as per NPV, you just have to write the answer as per NPV. Okay, as per NPV, or let us, because one more information is there, so let us complete it in the same table itself. What is the next requirement? Calculate the payback. Okay, calculate the payback period. Sir, what is the formula for payback period? Sir, what is the formula for payback period? Payback period is nothing but not discounted payback period. So payback period is nothing but initial cash flow divided by annual cash flow. What is my initial cash flow? My initial cash flow is 16. What is my annual cash flow? My annual cash flow after taxes is 3.3. Upon I have to calculate something called as payback period. Sir, next, payback period. Just a moment. So next one, payback period. Payback period का formula is initial cash flow divided by annual cash flow after taxes. Okay, annual cash flow after taxes. Sir, Appa, what is my initial cash flow, sir? My initial cash flow is 16. What is my annual cash flow after taxes? 3.3. Sir, 24, 36, 64, 150. okay, by 5.2, by 9.3, by 18.2, and then by 32.5. okay, 32.5. everyone please quickly tell me what is the answer. Okay, quickly, I want the answer. It is how much years? 4 point, okay, 848 years. Here how much years? 4.615 years. Here how much years? 3.871. Are you all with me? Hello. Okay, so now 64 by 18.2 is how much? 3.516. okay, so 3.516, and the next one is 4.615. Sir, where my payback period is lowest? Again, the winner is this. Your payback period is lowest here. Sir, always it will be same? No, not. Okay, it is not compulsory that it will be same only. I mean, the answer will be same only. Sometimes there can even be conflict between NPV and payback period. Yena, NPV includes time value of money. Payback period does not include time value of money. Yeah, discounted. If you are calculating discounted, probably it could be same. But yeah, here it is not same. Okay, it will not be same. But here it is same. Hey, are you all with me? Sir, appana, even if you are seeing from the technique of payback period, 6 inches is correct. And even if you are seeing from the technique of net present value, 6 inches is correct because it is. So lastly, you just have to write the answer. Okay, lastly, you just have to write the answer. Sir, what is the answer? Okay, NPV highest in 6 inches pipeline, and then payback period lowest in 6 inches pipeline. So what is my NPV? 27.35. What is my payback period? 3.516 years. Okay, 3.516 years, or okay, this 0.516 multiply by 12, you will get 6 months. Okay, or 3 years and 6 months. Okay, therefore, yeah, see what they have asked. Ayyo, just a moment. By mistake, na close pannita. Just a moment. Then questions. Okay. Okay, sir. So what they've asked you to recommend. Okay, they have asked you to recommend. So how should you present the answer? You have to present the answer. Therefore, it is recommended. Okay, therefore, it is recommended. It is recommended to invest in pipeline of 6 inches. Okay, 6 inches. With this question number 1 is completed. Okay, it is a typical 7-mark problem that could be asked in the examination. Sometimes it can even be asked more. For example, if they also ask you to calculate profitability index and blah blah, discounted discounted payback period and all, then this problem can become big and all. But yeah, this is how you have to solve this problem. Are you all with me? So solution to question number 1 is completed. Sir, let us go on to the next one. Question number 1. So question number 2. Complex Limited. Okay, Complex Limited, an infrastructure company. Okay, Complex Limited, an infrastructure company, is evaluating a proposal to build, operate and transfer a section of 20 kilometers of road at a project cost of 400 crores. So 400 crores to be financed as follows. Equity share capital of 100 crores. So this 400 is financed. Equity of 100 crores, which means debt of 300 crores. Equity of 100 crores and loans at the rate of interest of 15% per annum from financial institutions of 300 crores. The project after completion will be open to traffic and a toll will be, so investment is 400 crores pa, and they are also telling how they have financed 400 crores. So why they are telling how to finance, sir? We will see next. The project after completion will be open to traffic and a toll will be collected for a period of 15 years. Okay, so 15 years is the life of the project from the vehicles using the road. The company is also required to maintain the road during the 15 years. So in that 15 years, I also have some annual cash flows. And after the completion of that period, it will be handed over to the annual toll highways authority at zero value. So which means scrap value is zero after 15 years. It is estimated that the toll revenue will be 100 crores per annum. So every year my revenue is 100 crores per annum. And the annual toll collection expenses, including maintenance of roads, will amount to 5% of the project cost. So 5% of the project cost, which is nothing but 400 into 5%. Okay. So 400 into 5%, 20 crores. Okay, 20 crores is my expenses. This is nothing but 20 crores is my expenses. The company considers to write off the total cost of the project in 15 years on straight line basis. So depreciation is straight line. For corporate income tax purposes, the company is allowed to take depreciation at 10% on WDV basis. Okay. So for corporate income tax, we have to take 10% on WDV basis. Okay, sir. 10% on WDV basis. The financial institutions agreeable for the repayment of the loan in 15 equal annual installments consisting of principal and interest. Now, whenever this word consisting of principal and interest is there, it means my installment should include principal and interest. It is nothing but EMI concept. Okay, equated annual value you have to do. Are you all with me? If they only tell 15 equal annual installments, apna what we could have done? 300 divided by 15. Every year I have to repay 20 crores. 20 crores I have to repay for the next 15 years. That is what. But now what I'm learning, I should not repay 20 crores alone. I have to repay something more than 20. That is what we have to know. Okay, that is what we have to know. So more than 20, I also have to work out the interest portion also, which means repayment of 20 plus interest. No, I have to calculate such amount. That amount should also include interest and that should also include the principal. Otherwise, that is will be the written down diminishing value. So two types of loan calculations are there. One is called as EMI calculation. One is called as diminishing value calculation. So this is EMI calculation. In lease, we will also do diminishing calculation. Don't worry. One problem I have put for that also. Calculate project IRR and equity IRR. So we have to calculate IRR. Sir, what is this project IRR and equity IRR, sir? Project IRR, total project cash flows we will take. What is the investment for the project and what is the return from the project. Equity IRR means we will take only the equity cash flows. What is the investment made by equity and what is the return which is getting to by the equity. Ignore the corporate taxation. Now, whenever ignore corporate taxation is there, you should be feeling very relief because now the tax impact on depreciation is not there. Otherwise, just imagine, suppose if the examiner is a sadist person like me, now what he could have done, this ignore corporate taxation, he will not tell. He will tell tax rate is equal to 50% or some percentage, let's say 35%. Okay, then what you have to do first, because for income tax WDV, again straight line, it is again very easy. So straight line method, it is very easy. My total cash inflow 100 crores minus cash outflow 20 crores, my operating cost. So 80 crores. In this 80 crores, I have to minus the depreciation. So how much is the depreciation? I have to first calculate, okay. So 400 project cost, so depreciation I have to calculate. Then, okay, divided by 15, okay, so divided by 15. Then from there, I have to minus taxes and then I have to add back depreciation to calculate cash flow after taxes. Suppose if this is a reducing balance method, now, first I have to calculate something called as depreciation schedule. I'm just telling you, if the question is WDV, now, I have to calculate something called as depreciation schedule. So opening balance, depreciation, closing balance. Because depreciation will be reducing every year. Then that 15 years reduced depreciation I have to minus and add back. So every year different cash flow after taxes will come. That becomes a little bit complicated. Are you all with me? So that is the reason they are putting ignore corporate taxation. But if I were the question paper setter, I will just put, okay, 15 years I will reduce it to 5 years. And then I will tell, okay, tax rate is equal to 30% WDV method. Okay. So up here you will go in the examination die. Not literally, okay, but question becomes a little bit lengthy. So now the question is a little bit simple. Explain the difference in project IRR and equity IRR. So first one, IRR calculation, you know pa. This project in equity, you see afterwards, but the IRR calculation I know. So first let me calculate the project IRR. Okay, question number 2. Okay, solution to question number 2. Solution to question number 2. Okay, sir, calculation of project IRR. Always, sir, how to calculate IRR? First write the formula. IRR is equal to lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Clarity, super. Sir, NPV calculation and all I have to do. First for NPV, I should know the cash flows. Okay, I should know the cash flows. So first calculation of discounted cash inflows. Okay, calculation of discounted cash inflows. And then I have to calculate the discounted cash outflow to calculate the NPV. Okay. So first one, here cash flow, present value, annuity factor. What is the discounting rate? Discounting rate is not given in the question. Sir, Abhina, what I have to do? First, I have to calculate the discounting rate also. Sir, what is the discounting rate, sir? The cost of capital. What is the cost of capital, sir? Which is nothing but the rate of interest of 15%, right? So, in this 15%, okay, in this, wait, it is given, right? Let me just see. Let me see the question. We don't even need the rates because they're asking IRR. So we have to guess the rate. Sir, how should we guess the rate, sir? 1 minute. Ayyo. Sir, how should we guess the rate, sir? I will come to the guessing afterwards. And then I have to calculate discounted cash flows. 1 minute. To come to discounted cash flow. So this should be at lower rate, and then I have to again calculate present value annuity factor at higher rate and then discounted cash flow. Are you all with me? Super. Sir, 0th year, what is my outflow? Project, what is my outflow? 400 crores is my outflow. So project 400 crores is my outflow. Whatever be the case, it will be 400 crores. Because for 0th year, it is 400 crores. Now, sir, for 1 to 15 years, how much is my cash inflow, sir? What is my cash flow after taxes? You all know cash flow after taxes. Okay, calculation of cash flow after taxes. No depreciation is there. That is the reason it is becoming very simple. Okay. Sir, what is the cash flow after taxes? First toll revenue. Okay, first toll revenue. How much is the toll revenue? 100 crores. Next, is there any cash expense? Yes. Maintenance cost. Okay, minus maintenance cost. Sir, what is my maintenance cost? 5% of the project cost. Okay, so which is 400 into 5% comes to 20. No depreciation, I have to minus. Sir, why sir you are not minusing depreciation? See, minus depreciation, tax is not that. Again, add back depreciation, it will come same impact only. Lot of people make this mistake. They will minus depreciation and all because depreciation rate and all is given. Sir, why? To confuse you guys. Are you all with me? To confuse you guys. Appa sir, what is my cash flow after taxes? You know, ignore taxation. So cash flow after taxes is 80. So my cash flow 1 to 15 years it is 80. Now sir, what should be the lower rate and what should be the higher rate? Sir, how should we take a guess? Ayaga Gavani now. Okay, just how should we take a guess? Whenever you don't know how to guess, see the payback reciprocal. That is what is the average return. Appa sir, what is the payback period here, sir? 400 divided by 8. Okay, wait. 400 divided by 80. Sorry. So 5 years is the payback period. 5 years is the payback period. So 1 divided by 5, 20% is the approximate return. Okay, 20% is the approximate return. Are you understanding? 20% is the approximate return. So, or payback period, you just have to, if you have any table, so 20% is the approximate return. So what I will do, I will take the guess rate as 15%. Okay, I will take the guess rate at 15% and then 20%. Okay, you can take 15, 25, you can take 18, 20, whatever you want, you can take. So I am just taking for the sake, first at the rate 15%. Okay, 15%. Sir, how to calculate present value annuity factor of 15% for 15 years? Sir, 1 divided by 1.15. This is for the first year. Are you all with me? Okay, so 1 divided by 1.15, first year 1. Then if you don't have GT, then you have to press M plus equal to M plus equal to M plus equal to. I hope you guys know present value annuity factor calculation till now. Okay, so 1 divided by 1.15, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Then you have to press grand total. 1 divided by 1.15 equal to 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So you're getting 5.847. Okay, 5.847 multiplied by 80, you will get 46.779. Okay, you will get 467.76. Really sorry. 80 into 5.847, 467.76. Okay, 467.76. Let me just double check. 1 divided by 1.15 equal to first year 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Then MRC 5.847. Okay, 5.847. Clear. Sir, higher rate. Sir, first let us see what is the NPV. Okay, what is the NPV? It is 67.76. Sir, 15% it is possible now. It is positive now. Now you have to take it as 20%. Okay, you have to take it as 20%. Sir, what if 20 is also positive? Then just go to 22, 23. Okay, based on the number. I'm just assuming. Okay, now 20. Again, 1 divided by 1.2 equal to. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Which is nothing but 4.675. So 4.675 multiplied by 80 I will be getting is 374. A I'm getting negative. Okay, I'm getting negative. So which is nothing but negative 26. Okay, negative 26. Sir, which means what is my IRR? Okay, my IRR is equal to lower rate 15 plus NPV at lower rate 67.76 divided by NPV at lower rate 67.76 minus NPV at higher rate. So minus of minus is becoming plus. Okay, so minus of minus 26. So it is becoming plus, multiplied by higher rate minus lower rate, which is nothing but 20 minus 15. Are you all with me? Sir, which is coming to what? 15 plus. Okay, so 67.76 plus 26 is equal to 93.76. Okay, 93.76. So 67.76 divided by 67.76 divided by 93.76 multiplied by 5. Okay, multiplied by 5, you will get the IRR. 67.76 multiplied by 5 divided by 93.76, you are getting 3.61 plus 15, so 18.6 percentage. Clarity. So what you are getting? 18.6 percentage. So therefore IRR is equal to 18.6 percentage. So this is what is the IRR. See, sometimes if you're taking two different rate, now your IRR will be different. In your book, they are taking some 18 percentage and 19 percentage. You will get some approximate IRR. So in your book, your answer will be 18.4 percentage. But don't worry, they will see the method. So this answer is correct. 18.6 percentage is correct because you are taking the guess rate as 15 and 20. Are you having this clarity? So therefore my IRR, so which is nothing but my project IRR is equal to 18.6 percentage. Are you all having this clarity first? Super. Sir, how should I calculate equity IRR, sir? Let me just give you a thing. So equity IRR is nothing but year cash flow. Here 0th year you should take only the equity related cash flow. Sir, what is my equity related cash flow, sir? What is my equity related cash flow, sir? My equity related cash flow is, just one moment. My equity related cash flow is my cash outflow is how much? 100, 100, right? 300. So this is 100. Okay, this is what is the 100. Wait. Questions. Okay, so 100. Okay, 100 rupees is my investment. Sir, what is my cash inflow? Sir, what is my cash inflow? See here how you should see. Okay, here how you should see. 80 I am receiving. Correct. 80 I am receiving. Out of this 80, my one cash flow will go to the debt holders. Upper remaining cash flow is only available to the equity shareholders. Correct. So here you see this 80 I am getting, right? Cash flow after taxes. Now from here I also have to pay off the interest. So this is cash flow after taxes. Now I have to pay off the interest also. I have to pay off the principal repayment also. Correct. So first I have to calculate the what is the equity cash flow. Okay, cash flow available for equity shareholders. Sir, cash flow available for equity shareholders, same thing only, pa. Toll revenue 100. Then maintenance cost will go, okay. Maintenance cost will go, which is called to 20. Then minus payment to debt holders. Payment to debt holders means principal plus interest. Now, if you minus this, you will get cash flow available for equity shareholders. Okay, so cash flow available for equity shareholders. Sir, how to calculate payment for debt holders, sir? First I have to calculate what is the EMI amount. Sir, how to calculate the EMI amount, sir? My EMI amount is nothing but, you all should know this, EMI amount is loan amount divided by present value annuity factor of the loan percentage. What is my loan percentage? My loan rate 15% loan, correct? 15% loan is there, right? See, 15% loan. So which means divided by 15%. How much years loan I'm taking? I'm taking a loan of 15 years. Clarity. So loan amount. Sir, I know what is my present value annuity factor for 15 years. 5.847. Clarity. 5.847. So which is nothing but my loan amount is 300 divided by 300. You should not take 400. 300 is my loan amount divided by 5.847. Okay, 5.847, which means 300 divided by 5.847. Every year I have to pay 51.308 crores. Okay, every year I have to pay how much? 51.308 crores. So 51.308. So which is nothing but 100 minus 20, 80. So 80 minus 51.308, which is coming to 28.692 is the cash flow available for the equity shareholders. So 1 to 15 years, every year how much I'm getting? Every year the equity shareholders are getting 28.692. Okay, so 28.692. Okay, 28.692. Sir, how to guess the rate, sir? Payback reciprocal calculate panapa. Okay, so investment is 100 divided by 28.692. You are getting 3.485, right? 3.485. Just do 1 divided by the number. You are getting 28.7%. So 28 na take 27 and 30. Okay, take 27% and then take 30%. Okay, so what you have to do? Present value annuity factor at the rate 27% and discounted cash flow. Then present value annuity factor at the rate 30% and then take discounted cash flow. Okay, this is 1, so 100, 1, so 100. So now what you have to do? 27% and 30%. Please calculate what is the present value annuity factor. 1 divided by 1.27. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So you're getting 3.6. Okay, 3.6. Same way, 1 divided by 1.3. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. You are getting 3.268. So 28.692 multiply by 3.6, I'm getting 103.29. See, just a miss, positive, and multiplied by 3.268, I'm getting 93.765. Okay, 93.765. So 100 minus 103.29 is 3.29, and 100 minus 93.765, it is negative 6.235. What is my IRR? My IRR is equal to lower rate 27 plus NPV at lower rate 3.29 divided by NPV at lower rate minus NPV at higher rate, which is nothing but 3.29 plus 6.235, which is coming to 9.525 multiplied by lower rate minus higher rate minus lower rate, which is nothing but 3. So what is my IRR? My IRR is equal to 3.29 multiplied by 3 divided by 9.525, which is coming to 1.03 plus 27. So my answer is 28.03%, or it is nothing but 28%. Clarity. So which means my equity IRR is equal to 28% and my project IRR is 18.6%. So 18.6% and 28%, which means as an equity shareholder, if I see my IRR is 28%, but the project is giving me 18.6 percentage. Sir, what is the difference, sir? This difference 10 percentage is what, sir? This different 10.6 percentage is the leverage that you're getting from the debt. Because project is giving you 18.6 percentage. You took loan at what percentage? 15 percentage. Correct. So you took the cash, used that cash, generated 18.6 percentage, paid back 15 percentage. So this 3.6 percentage is the leverage that you're getting. Okay, this 3.6 percentage is the leverage that you're getting. Are you all with me? This 3.6 percentage is the leverage that you're getting. So that is the reason you're having equity IRR of 28 percentage. So that is what is the something. Okay, that is what is something that you have to consider. Okay, because I'm earning 18.6 percentage, but I'm paying how much? 15.6 percentage. So this extra amount is actually enhancing, it is increasing my equity IRR. Okay, it is my enhancing my equity IRR. This much clarity you're having. Okay. Okay, super. So with this, question number 2 is also complete. Okay, with this question number 2 is also completed. Okay, now let us jump on to the next question, question number 3. Okay, let us jump on to the next question, question number 3. Okay. X Limited. Okay, X Limited, an existing profit making company. Okay, X Limited, an existing profit making company is planning to introduce, okay, it is planning to introduce a new project of life 8 years. So 8 years is my life of the project. Okay, 8 years is my life of the project. And initial equipment cost will be 120 lakhs. And additional equipment costing 10 lakh rupees will be needed at the beginning of third year. Beginning of third year means end of second year. Okay, always you just should know that this is nothing but year 2 cash flow. Okay, year 2 end I have to spend some amount. At the end of the years, the original equipment will have the resale value equipment to the cost of removal. At the end of the original equipment will have resale value equipment to the cost of removal, but the additional equipment would be sold for 1 lakhs. Working capital of 15 lakhs will be needed. The 100% capacity of the plant is of 4 lakh units, but the production and sales volume are expected as under. So first year only 20% capacity I'm running, so which means 4 lakh into 20% units I'm producing. Second year 30%, 3 to 5 years 75%, and 6 to 8 years 50%, which is nothing but every year number of units are changing. So every year number of units are changing now, into selling price, sales will change, variable cost will change, and then cash flow after tax will change. Sale price of 100 per unit with a profit volume ratio of 60%. So contribution is 100 into 60%, which is 60 rupees is the contribution every year. Fixed operating cash costs are likely to be 16 lakhs per annum. In addition to this, advertisement expenditure will have to be incurred. So every year some fixed cost also changing. The company is subject to 40% tax, straight line method of depreciation, permissible for tax also. So which means depreciation and tax impact. So minus, so what you have to do? Sales minus variable cost is contribution. Contribution minus fixed cost minus advertisement expenses is equal to cash, is equal to profit before tax. Sorry, before depreciation and taxes. EBITDA minus depreciation is equal to earnings before tax, minus tax is equal to profit after tax, plus depreciation is equal to cash flow after taxes. Likewise, you have to calculate plus depreciation, and then you will get the cash flow after taxes. Then that cash flow after taxes 15% you take it as the after tax cost of capital, and then you have to calculate the NPV. You have to calculate the NPV. If the NPV is positive, accept. If the NPV is negative, you have to reject. Are you all with me? Question understood? Okay. So let us try to solve this. Okay, let us try to solve this. Before that, let me see if there is any mistake here. Is there any printing mistake? Let me just check. Okay, nothing given. So in this problem, two new points are there. One point is that every year different cash flows are there. Second is that two equipments are there, so two depreciation will come. Okay, two depreciation will come. Now, two depreciation will come, but a lot of people, what mistake they will make is that this 120 lakhs is used for 8 years. So this depreciation is 120 divided by 8, which is nothing but 15. 15 years is the depreciation. But this 10 lakhs that I am using, right? This I am using it only in the beginning of the third year. So at the end of year 2, I am investing. So 3, 4, 5, 6, 7, 8. Only 6 years I am using. So 10 divided by 6, 1.67. This is what is the depreciation. Okay, 1.67. This is what is the depreciation. Because I am only using it for the beginning of the, so 3, 4, 5, 6, 7, 8. Wait, I also have, so 9 by 6, sorry, 9 by 6. I also have the scrap value, right? So scrap value is minus 1 lakh. So 9 by 6. So what is 9 by 6? 9 by 6 is 1.5. Okay. So 1.5 is the depreciation. Now this 1.5 depreciation will start from third year. Are you understanding? Which means, sir, what is the depreciation, sir? First year 15 lakhs, second year 15 lakhs. Third year 15 plus 1.5, 16.5. 3, 4, 5 is 16.5 and this also 16.5. This is what something you have to remember, pa. Are you all with me? So first thing, calculation of depreciation. Okay, first thing, calculation of solution to question number 3. Solution to question number 3. First thing, what you have to do, calculation of depreciation. Okay, calculation of depreciation. Okay, so depreciation for original equipment. What is depreciation? 120 by 8. Okay, so 120 by 8 is equal to 15 lakhs. Then depreciation for additional equipment, 10 lakh minus scrap value divided by 5 years. So 9 by 5 is 1.5. Okay, 1.5 lakhs. Are you all with me? $15 lakhs and then 1,50,000 rupees. This is what is the depreciation. But this depreciation we have to use for 1 to 8 years, and this depreciation you have to use for 3 to 8 years. This is something that you have to remember. Okay, sir, next one, what, sir? Next one, just draw a table. Okay, contribution minus fixed cost. You just have to calculate the cash flows. Okay, you just have to calculate cash flows. So which means how, sir? So capacity, years 1, 2, 3, 5 and 6. Every year different cash flows are there, right? So cash flow for first year, cash flow for second year, cash flow for 3 to 5 years, and cash flow for 6 to 8 years. Okay, cash flow for 6 to 8 years. Okay, sir. First one, number of units. Okay, first one, number of units. How much units I'm selling? 20%. Okay, 20%. So 4 lakh into 20%. 4 lakh into 30%. Clarity. 4 lakh into 20% is 80,000 units. Okay. Then next one, 4 lakh into 30%, 1,20,000. 4 lakh into 75%, it is 3 lakh units, right? It is 3 lakh units, and then it is coming to 50%. So 4 lakh into 50% is 2 lakhs. Sir, which means this is nothing but number of units. Now I have to calculate something called as, either I can do directly sales minus variable cost is equal to contribution, or directly I know the PV ratio, contribution is 60 rupees per unit. So directly I can calculate contribution. Sir, what, how much number of units into rupees 60 per unit. So nothing but 60 into 80,000. Okay, 60 into 80,000. How much? 48 lakhs. 60 into 1,20,000, 72 lakhs. 1 crore, 80 lakhs, and then 1 crore 20 lakhs. Sir, minus fixed cost. How much is the fixed cost every year? 16 lakhs per annum. Okay, 16 lakhs per annum. So minus 16 lakhs. Sir, next, advertisement spend. How much is the advertisement spend? First year 30 lakhs, second year 15 lakhs. Okay, 30, 15, 10 and 4. So 30 lakhs, 15 lakhs, 10 lakhs, and then 4 lakhs. So this is what is the advertisement spend. So contribution minus fixed cost minus advertisement spend. Next, what's the depreciation? Minus depreciation. Two depreciations are there. Depreciation for original equipment and then minus depreciation for additional equipment. Or what you can do, you can directly add these both, but just for clarity I'm doing. So what is my depreciation for original? 15 lakhs. Sir, what is my depreciation for additional investment? 1,50,000. But first year I didn't purchase, second year I didn't purchase. From third year only depreciation. Second year end I have purchased, but depreciation will come from third year. So how much? 1,50,000. Okay, 1,50,000. Now this is what we call it as profit before taxes. Okay, profit before taxes. Then how much is the tax rate? Your tax rate is 40%. Okay, your tax rate is 40%. Then minus, I have to do minus tax at the rate 40%, and that will give me the PAT. Then I have to add the depreciation, and this is what is my cash flow after taxes. Okay, this is what is my cash flow after taxes. Sir, what is my profit before tax, sir? 13 lakhs here. Negative. Okay, 13 lakh loss. Correct? Don't consider this number of units and all. Okay, this is just a calculation, working note. Okay, number of units is just a working note. So 48 minus 16 minus 30 minus 15 is equal to 13 lakhs. Okay, 13 lakhs. So next one, 26 lakhs. Come on, calculate. Tell me what is the next one. Okay, 1 crore 37 lakh 50,000. Next one, 83 lakh 50,000. Correct? So 180 minus 16 minus 10 minus 15 and minus 1.5 is 137.5. Okay, sir, tax at the rate 40%. Now one more thing, one more point I want to tell you here. Because it is a loss, so we are not paying any tax. Anyways, we will not pay any tax. The question tells that it is an existing profit making company. It is an existing profit making company. So which means in some other place they are making a profit. So in the first year, if I am making a loss, ideally I will get a tax benefit. Ideally, I will get a tax benefit that I have to consider. Okay, ideally I will get a tax benefit, which means what, sir? This 40% will be added back. This 40% will be added back. So benefit I will get. But you know, in your study material, even though they are giving this sentence, existing profit making company, they have not considered this as a tax benefit. They have just put zero taxes. See, three things are possible here. First thing, you have to take the tax benefit. Second thing, you have to carry forward the loss to the next year if there is no set off possible. Third thing, you have to ignore. Now here they have ignored. Okay, only three things are possible. Ideally, in my opinion, because the sentence given is existing profit making company. So existing profit making company means what? They are having lot of projects where they are earning profits. And this one project, first year they are making a loss. So first year, because they are making a loss, what I should be doing here? I will taking the benefit of this loss into the profits of other businesses. So I will save some amount there. So saving amount there is equal to saving amount here. So I should get a tax benefit here. Ideally, I should be getting a tax benefit here. Okay. But in your textbook, they are ignoring. So that is the reason. Okay. We are also ignoring. Otherwise, it should be a tax benefit, which is what? 13 lakh into 40%. 5,20,000 should be added. Instead of minusing the tax, I have to add. So my PAT will be 13 minus 520. Clarity, but this is not done. Instead, what they have done here is that they have just ignored this. So your PAT is 13 lakhs. Clarity, but okay, both the ways. You just have to write a note, taxes are ignored. Okay, or you have to search in the question. If somewhere they have given that loss, they have to ignore. Nothing they have given like this. Okay. Okay, now next one. 26 lakh upper tax is how much? 10 lakh 40,000. Next year tax is how much? 55 lakhs. Okay, 13750 into 40%. Next, how much? 33 lakh 40,000. So how much is my PAT? 15 lakh 60,000, 82 lakh 50,000, and then 50 lakh 10,000. I have to add back the depreciation. Sir, how much I have to add back here? 15 lakhs I have to add back. How much I have to add back here? 15 lakhs I have to add back. How much I have to add back here? 15. No, 15 plus 1.5. 2 depreciation, right? So 16 lakh 50,000. Or you put 2 times. Okay, why to waste time? So 16 lakh 50,000. So what is my cash flow after taxes here? 2 lakhs. How much is here? 30 lakh 60,000. How much is here? So 82, 83. So 99 lakhs. 99 lakhs. And how much is here? 66 lakh 60,000. Okay, so this is what is your sorry. So 66 lakh 60,000. Okay, so this is what is the cash flow after taxes. So once you know cash flow after taxes, now the things becomes very simple. Okay, now the things becomes very simple. And annual cash flows you have calculated. Always the question is being done in 3 ways. Step number 1, initial cash flow. Always remember, now I'm giving you a structure. Step number 1, initial cash flow. Step number 2, annual cash flow. Actually, this should be the second step. And step number 3, terminal cash flow. Okay. Sir, what is the initial cash flow? Initially, what you're doing? Purchase of equipment, correct? So purchase of equipment. At what price you are purchasing? At 120 lakhs you are purchasing. Okay, so at 120 lakhs. So 120 is the outflow. Next, what is outflow, sir? See, working capital investment is there, pa. 15 lakh rupees is the working capital investment. So working capital investment, it should be added in the initial cash flow, which means invested in the initial cash flow and recovered in the terminal cash flow. That is the adjustment. This is one adjustment you have to remember. Okay. and then working capital investment. How much? 15 lakhs. So how much is my initial cash outflow? My initial cash outflow is 135 lakhs. Second one, terminal cash flow. Terminal cash flow. Sir, in terminal cash flow, what you will get? Whatever is a scrap value, what if at all it is there, na scrap value will be there. Okay. So first one, what is the salvage value? Original equipment is having no salvage value, but that additional equipment is having, right? Salvage value of additional equipment, because original equipment no salvage value. How much? 1 lakh. Are you getting or you're losing? You're getting. Okay. See here, the tax impact on the sale is being ignored. Okay. Otherwise, if WDV method of depreciation is used, then you have to compare the book value and salvage value. So if the book value is less and salvage value is more, it is profit. So you're getting profit, na capital gain, na tax expense will come. So either tax expense will come or tax benefit will come. So salvage value of additional equipment plus working capital recovery. Plus working capital recovery. How much is my working capital recovery? 15 lakhs. So I'm getting 16 lakh rupees. Actually, you put it in lakhs. Okay, everywhere I'm putting lakhs. So here also you put in lakhs. So this is what is my terminal cash flow. And don't forget don't forget you have also invested initial cash flow. It is always year 0. This is terminal na year 8. Okay, year 8. Initial na year 1 to 8. Now calculation of NPV. Now this is the important part. Calculation of NPV. Sir, how to calculate? Year cash flow present value factor at the rate. What is my discounting rate? 15%. Okay, at 15% and then discounted cash flow. Sir, 0th year, how much I'm investing, which is what is initial cash flow? 135 lakhs. Okay, so 135 lakhs I'm investing. Okay, 1 crore 35 lakhs. Sir, next one, 1 to 8 years. So 1, 2, then 3, 4, 5, then 6, 7, 8. Likewise, I have to do 1 to 8 years. But don't forget, second year you also have an investment. This thing you should never forget. So which means first year you're getting an inflow, second year you're getting an inflow, but second year you're having one more outflow. Sir, what is my first year inflow? 2 lakh 30 lakh 60,000. Okay, so 2 lakh 30 lakh 60,000. But I am also investing something called as 10 lakh rupees in the equipment. Okay, 10 lakh rupees in the equipment. This is something that I have to take care. Okay, this is something that I have to take care. That additional equipment I am purchasing, right, for 10 lakh rupees. Correct? That I am purchasing at the end of second year. Okay, at the end of second year. So next one, 3, 4, 5, 6, 7, 8. Sir, what is 3, 4, 5? 99 lakhs. 3, 4 and 5 is 99 lakhs. Hey, you all will be considering, sir, 3, 4 and 5 and divide by 3. No, pa, this is annual cash flow. Third year also I am selling 3 lakh. Fourth year also I am selling 3 lakh. Fifth year also I am selling 3 lakh. So this is my annual cash flow. Sir, upon depreciation, we directly did divide by 8 only. Na? We are not divided by 4. Understanding this. So 99 lakhs. 99 lakhs. And 99 lakhs. Sir, 6, 7, 8 is how much? 66 lakh 60,000. And do not forget, terminal year, one more cash flow we are getting, which is nothing but 16 lakhs. Lot of people will make mistakes here, This is one mistake that lot of people will do. This is one mistake that lot of people will do. They will forget the additional investment of 10 lakh rupees. And then 8th year terminal, lot of people will forget, Okay, while calculating NP 1, 2, 3, 4, 5, 6, 7, 8, 8. This is one mistake. Okay. Now, present value factor for 15%. Quickly, present value factor for 15%. So 0.8696, 0.7561, 0.6575, 0.5718, 0.4972, 0.4323. Then wait. One more mistake that one more people will do here is that this 0.7569 will come two times, right? 0.7561 will come two times. So 0.75. And this is also second year, this is also second year. Understanding. Then 0.6575. 1 divided by 1.15. 86967561 6575 0.5717. Sorry, 5718. Always do one thing. This rounding off problem, lot of people will be having. Always last digit you have to round off. 0.497. Round off means if it is more than 5. Okay, not always. If the next digit is more than 5 or more, you have to round off. 0.4972. 0.4323. 0.3759. Then 0.3269. One more mistake that a lot of people will be doing here is 0.2843, but actually it is again 8th year. So it is again 0.3269. Lot of people will do this mistake. So you should not do this mistake again. Are you all with me? Clarity. Now multiply. Okay. So what is 2 lakh into this? 2 lakh into this is 1,73,920. Yeah, 1,73,920. 30 lakh 60,000 into 775. 23 lakh 13,000. Wait. 2 lakh into 0.8696. Wait. 2 lakh into 0.8696. 1,73,920. 30 lakh 60,000 into 0.7561. 23 lakh 13,666. 10 lakh into 0.7561 is equal to 7 lakh 56,100. Okay. Then 99 lakh this into 65 lakh 9,250. Next one 56 lakh 60,820. Next one 49 lakh 22,280. Next one 28 lakh 79,118. Next one 25 lakh 3,494. Next one 21 lakh 77,154. Okay, 154. Salvage only na. Then 16 lakhs into 0.3269, which is nothing but, wait, 5 lakh 23,000. And this is how you have to calculate the NPV. Okay, this is how you have to calculate the NPV. Okay, in your workbook, one mistake is done here is that this 1 lakh they've reduced it. Okay, they 1 lakh they've reduced it, but it is an inflow. So this is a mistake that you have to consider. Okay, I mean you have to not make this mistake. So now what you have to do, you have to add back everything. Okay, so 173,920 plus 23 lakh 13,666 plus 7 lakh 56,000 negative. One more mistake that a lot of people will do, understanding negative, right? So 173,920 plus 23,13,666 minus 1 crore 35 lakhs minus 756 100 plus 65 lakhs 09250 plus 56 lakhs, okay, 56 lakhs 60,820 plus 49 lakh 22,280 plus 28 lakh 79,118 plus 25,03,494 plus 21,77,154 plus 5 lakh 23,040. So how much you are having? You are having 1 crore 34 lakh 6,642. Since your NPV is positive, you have to accept the project. Okay, you have to accept the project, because what they are asking whether the project should be accepted or not. So the answer should be yes, the project should be accepted, because huge enormous profit you are getting, 1 crore and all NPV you are getting now. Please go ahead and accept the project. So that is what is question number 3. Are you guys having this clarity? So question number 3. Okay, so question number 3. Now we will take a small, okay, I'll take a small break and then let us continue with the next set of questions. Okay, probably some 10 to 12 questions are there, okay, in investment decisions that I've done. Okay, in investment some 10 to 12 questions I've covered for you. So we will be solving. If time is not permitting, instead of me solving, probably I can also go through the questions. Okay, that is also possible. Let us see. I will try to solve most questions, but I will go through the questions. Okay, so let us take a small break and then we will be coming back. So let us start with problem number 4. So problem number 4 is a replacement decision problem. See, in investment decision problems, okay, in investment decision problems, mostly 3 types of problems are possible. Problem type number 1 is that using the techniques on capital budgeting. For example, they will ask you to calculate IRR, they will ask you to calculate payback period, discounted payback period, or they will ask you to calculate MIRR, MNPV, adjusted NPV. This problem is possible. Second one, standard case study, which is nothing but some case study they will ask, and then they will ask you whether it is recommended to invest or not. So till now we were solving standard case study. Third one, replacement decision problem. And then we also have capital rationing decisions. These are the 4 types of problems which are possible. In the examination, mostly you will get 100% you will get one problem from here. A lot of time problems are asked from here, and from these 2 any one problem they can be asking. So standard case study problem, replacement decision problem, capital rationing decision problem, and then techniques of capital budgeting. These are the 4 types of problems from where questions can be asked. Are you all with me? Okay. Now, sir, now you all know how to calculate IRR. See, in IRR, we have an underlying assumption that the intermediary cash flows are reinvested at IRR rate. So just a check. Okay, this is just a check I wanted you to show. For example, if I'm reinvesting this 20 for the next 4 years, in a first year end, I'm getting 20. So I'm reinvesting it because I want all the cash flows in year 5. So what I'm doing, all the cash flows that I'm getting, again I'm reinvesting. So 20,000 I'm reinvesting for 4 years. 30,000 I'm reinvesting for 3 years. Why? Because at the end of second year I'm getting, so 3, 4, 5, 3 years I have to reinvest. So if I'm reinvesting all the 4 cash flows, so reinvest in a future cash flow, because 20,000 at the end of 4 years, what it will be? So 20,000 into 1 plus I to the power n. Sir, IRR is 16.87. We already calculated, right? IRR is 16.87. So what I'm doing, I'm reinvesting it IRR. If I'm reinvesting it at IRR, I will get 2,58,268 as my year 5 cash flow. It is also called as terminal cash flow. It is also called as terminal cash flow. Sir, year 0, I've invested 1,20,000. Year 5, all the cash flow say that I'm getting 2,50,268. Actually, I'm getting 20, 30, 40, 50, 60. But I'm not taking, I'm again reinvesting it at. So if I'm again reinvesting, this is my cash flow pattern. Now, if this is my cash flow pattern, I have to calculate at what rate it is growing. That rate is called as, okay, that rate is called as modified internal rate of return. But here, just to show you how 16.87, if you do, you will get again answer 16.87 only. This is approximately 16.87 only. So basically in IRR, there is an underlying assumption that the intermediary cash flows are reinvested at IRR rate. But actually it may not be correct. Probably my reinvestment rate will not be equal to 16.87. Let us say my reinvestment rate is cost of capital only, which is 10%. So in that case, you will get some rate. Sir, IRR 16.87% is correct only if reinvested cash flows, only if intermediary cash flows are reinvested at IRR rate. Suppose I am not reinvesting it at IRR rate, it means that my IRR is not correct. So that is something called as modified IRR that we have to calculate. Okay, sir, how to know what is the reinvestment rate? In the question, if they are asking you to calculate modified internal rate of return, and if they are not giving the reinvestment rate, it means the discounting rate is a reinvestment rate. If they are giving, then that is the reinvestment rate. Sir, what I have to do? Same calculation I have to do, but instead of 16.87, I am taking the discounting rate, which is 10%. Okay, which is 10% reinvestment rate. If I do this, I will get the rate as 14.15%, and this 14.15% is the modified internal rate of return. Sir, how to calculate? Same only present value into 1 plus I to the power n is equal to future value. You all know that. What is the present value? 1,20,000. What is the future value? 2,32,000. What is the year number of I? I you have to calculate. How to calculate I? So same thing you have to do. 1 plus I is equal to fifth root. You have to calculate fifth root. Sir, how to calculate fifth root, sir? There is a method in calculator. Okay, there is a method in calculator. First type that number, then press square root 12 times, minus 1 divided by nth root plus 1 and multiply equal to 12 times. If you do this, you will get this result. Okay, you will get this result. If you are not understanding, pause this video, see this, try solving it in the calculator. So you will get this also. Okay. So in IRR, we have an assumption that intermediary cash flows are reinvested at IRR rate. Sometimes this may not be the assumption and reinvestment rate is not equal to IRR. In that case, reinvested at reinvestment rate. But what is the reinvestment rate, sir? It is discounting rate if question is silent, or take whatever is the rate which is given in the question. Okay. So then you will get the MIRR of 14.15%. Sir, what is the formula, sir? Same thing only nth root into terminal value divided by initial cash flow minus 1. This formula is coming from here only. Future value by present value, nth root minus 1. Same thing only. This is the formula. If you do it from the formula, you will also get 14.15%. Clarity. Logically, I am just discussing MIRR. So this is one problem for MIRR. Okay, this is one problem for MIRR that we have seen. Sir, what is MNPV, sir? Same this thing you are having, right? This 232,612 is a 5th year cash flow. Do it in the present value and calculate NPV. So year and cash flow you are having, right? If you calculate the NPV, that is what is the modified NPV. Sir, my NPV was somewhere around 40,000, right? What was my NPV? My NPV was somewhere around 24,410, correct? 24,410 was my NPV. So if you see my modified NPV, it will not be 24,000. It will be lesser than 24,000. Okay, it will be 24,334. Wait, 232,632. 232,612. If you discount it at 10%, you will get 24,334. Okay, 24,334. Okay, so this is what is the NPV. 20, 30, 40, 50, 60. Present value 10%. So this much clarity you are having. So modified NPV and modified IRR is nothing but this is the same thing. Now, a very important thing. This is the main heart of investment decision. How problems will be coming. Format. Sir, first step, initial cash flow. What is the initial cash flow? What are all possible are there? Cash outflow for the project or purchase of machinery. That is the initial cash flow. Then you have to, again, that is an investment, so negative. Then investment in working capital, why red mark? Because it is an adjustment. What you are minusing here, you have to add in the terminal cash flow. You have to add in the terminal cash flow as a recovery of working capital. This much clarity you are having. So this is what is your initial cash flow. So annual cash flows all the years, sales minus cost, gross profit minus operating expenses, EBITDA minus depreciation, EBIT minus interest, EBT minus tax, PAT plus depreciation, you will get cash flow after taxes. Sir, why adding depreciation? Because you are reducing depreciation, adding depreciation. This is one more adjustment. Two adjustment you learned, working capital adjustment and then tax adjustment on depreciation. Third, terminal cash flow. Salvage value of machinery. Whenever sale of machinery is there, there could be some tax benefit or tax expense if book value of asset is given. So that you have to add or less, and then recovery or release of working capital, terminal cash flow. Sir, what if it is a replacement decision problem? Now, very much important, replacement decision. If it is a replacement decision, lot of things are happening in the initial year itself. In the initial year, first you will sell the old machinery. So selling the old machinery is an inflow. Now, whenever you are selling, you will have some capital gain or loss. So on that capital gain or loss, you will have some tax benefit or tax expense. So that you have to add or less. Then you will purchase a new machinery, less. Then installation charges, minus. And investment in working capital, it is an adjustment. Then again, annual cash flow, incremental revenue. Sir, old machinery 10 lakh was the revenue. New machinery 12 lakh is the revenue. So 2 lakh is the incremental revenue. Sir, savings in cost. Sir, old machinery, my spending was 10 lakhs. New machinery, I am saving some cost. So my spending is 8 lakhs. So 2 lakh savings in cost, inflow. Understanding? So revenue increasing is an inflow. Savings in cost is an inflow. Sir, incremental cost. Sir, old machinery, there was no supervisor needed, sir. New machinery, 2 supervisors needed, 2 lakh rupees. So 2 lakh rupees is the increase in cost. So that is the reason you have to reduce. Sir, old machinery, it was 10 lakh rupees. So depreciation was only 1 lakh rupees. New machinery, it is 2 lakh rupees. So depreciation is 2 lakh rupees. 20 lakh rupees is the purchase. So depreciation is 2 lakh rupees. So 1 lakh additional depreciation I am charging, sir. So 1 lakh additional depreciation you have to reduce. Then incremental profit before tax minus taxes, and then PAT, then add back that incremental depreciation to get incremental cash flow after taxes. Then terminal cash flow. Okay, then terminal cash flow, incremental salvage value. Sir, old machinery, had I been using, my salvage value would be 10,000. But when I'm purchasing the new machinery, the salvage value is 20,000. So incremental salvage value. Tax benefit or tax expense on sale. So whenever there is a sale, there is tax benefit or tax expense. And then recovery or release of working capital is an adjustment. Whatever you have reduced here, you have to add back here. So that is how the problem look. Okay. And then last calculation of NPV. So initial cash flow 0th year, annual cash flow 1, 2, 3, 4, 5. If 5 years are there, terminal cash flow 5th year, all the cash flows you have to write. Then discounting rate, you just discount all the cash flows, you will get discounted cash flow, then you will calculate NPV. NPV positive, accept or replace, and NPV negative, reject or don't replace. So this is how a replacement decision problem will look like. Are you all with me? So what is adjusted NPV? So adjusted NPV is nothing but base NPV plus the tax shield on interest expense that I'm getting, right? The present value of the tax shield on interest expenses and minus the present value of the flotation cost. Sir, what is happening? See, to calculate NPV, we use discounting rate. Discounting rate is nothing but weighted average cost of capital. Okay. And weighted average cost of capital is nothing but weight of equity into cost of equity plus weight of debt into cost of debt. Assuming always in problems, we assume that the weight of debt and equity is same as the capital structure of the company. Suppose my capital structure, my entire company's capital structure is 50 equity and 50 debt, then what I will be doing? 0.5 equity, weight of equity, 0.5 debt of equity into cost into equity, into cost of debt into cost of equity, I will multiply and then I will get KO, and this KO is used as a discounting rate. Are you all with me? See, this much advanced problem is not asked, but I'm just giving you the logic for what is adjusted. But basically what is happening? The project can be financed using different weight. Even though my company's capital structure is 50 equity, 50 debt, probably for this project of 100 lakh, I have taken 80 lakhs of debt and 20 lakh only I have used my amount. So this KO use pante you have calculated NPV, right? That is wrong. So what you have to do? You have to do some adjustment to change that KO. To change that KO. Are you all with me? So that is what is called as adjusted NPV. Sir, how to do that adjustment, sir? Either you calculate the new discounting rate and calculate the new NPV. But that's a long method. So there is a short method. Sir, usually what will happen? You will take entirely debt. Usually you will have entirely debt. So whenever debt is increasing, what will happen? Interest will increase. Whenever interest is increasing, what will happen? You will get some tax shield on interest. So do the present value of tax shield on interest, and that is a benefit. Add that tax shield on tax shield on interest expense. Sir, what is tax shield on interest expense? Suppose 1 crore is a loan taken. 1 crore into interest rate is 10%. So 10 lakh is the interest every year that you are paying. Now on this 10 lakh, you will get a tax shield. 50% is the tax rate. So 10 lakh into 50%, 5 lakh is the tax benefit that you are getting every year. This 5 lakh benefit you are getting for the next 5 years. So do the present value and add. Correct. And then suppose whenever you are taking a debt, some flotation cost will incur. That flotation cost alone you minus. You will get adjusted NPV. There is only one problem or two problems in the study material. Just see those adjusted NPV problem. Very simple and highly lot of problems. A lot of times this has been asked. Okay. So this is what we have discussed. Sir, what if there is a conflict between NPV and IRR? The conflict can be arising because of disparity in timing of cash flow, disparity in life of the project, and disparity in size of the project. Sir, what is timing of the cash flow? MIRR, MNPV, problem solved. Sir, what if life are different, sir? One project life is 4 years and one project life is 6 years. You have to calculate something called as annualized NPV. It is also called as equivalent annualized cost or equivalent annualized benefit. Okay, EAC or EAB. If it is an outflow na cost, if it is an inflow na benefit. So how to calculate is NPV divided by present value annuity factor. Period. Done. Nothing great. Sir, what is that? Basically, suppose my NPV for 4 years is 4 lakhs. My NPV for 6 years is 6 lakh. You should not tell 6 lakh is higher, go accept. No. This 6 years is for a life of 6 years. And this 4 lakh is for a life of 4 years. You cannot compare these two. But what I should do? I should annualize. So divide by 4 and divide by 6 and no. Divide by present value annuity factor for 4 years and present value annuity factor for 6 years. EMI calculation, Mari. So then you will get annualized NPV. Now that annualized NPV you compare and then you have to check. Okay, wherever it is the highest inflow, that alone you have to select. So if there is an so if the life is different, then you have to do EAC or EAB. Sir, what if there is a disparity in the size of the project? Which means one is a small project, so small NPV will be there. One is a large project, so large NPV will be there. Logically, you will go and select a large NPV, IPV is more, I am going to accept. No, size is different, right? Then what you have to do? You have to calculate something called as incremental IRR. So how to calculate incremental IRR? Put incremental cash flow. What is the incremental investment and what is the incremental cash flow? And calculate something called as incremental IRR. If the incremental IRR is more than the KO, then select the project whichever is having higher cash flow. If the incremental IRR is less than KO, then select the project whichever is having a lower IRR. Lower cash flow. Clarity. Okay. Now, whenever you are having disparity in the life of the project, there are two methods. Method number A is annualized NPV. Method number 2, it is not asked in the examination, but I am just giving you. We are making two lives as equal. Sometimes, okay, I think in last 11 or 12 years, one time it has been asked. Okay, 1 or 2 times it has been asked. So, in this method, the life is made equal. Sir, above one project is 2 years and one project is 3 years. Then what will happen? This project you will replace 3 times. This project you will replace 2 times. So both life will become 6 years. Then both are 6 years. NPV is comparable. You have to see what is the NPV. Okay. So whenever life is different, ideally you have to solve it using equivalent annualized cost. Okay, equal annualized cost or annualized NPV. It is also called as. Okay. Next one is abandonment value. Sir, should I abandon or should I continue? Some project already going on, sir. Should I stop this project or should I continue? How to take that decision? If the salvage value of project today, sir, today if I close this project, what is the salvage value that I'm getting? If that salvage value is more than the present value of all the future cash flows, it is better to close it today. So that is what you have to do. It's okay. Then that project shall be abandoned. So if at all this question is asked, that is how you have to solve. Sir, nominal and real cash flow, sir. Sir, nominal cash flow means without inflation. Real cash flow means with inflation. Real, so with inflation. Sir, what is real cash flow? Nominal cash flow into 1 plus inflation rate. Usually real cash flows only will be given. But if nominal cash flows are given, you have to convert it into real cash flow and then you have to discount it using real discounting rate. Sir, about the discounting rate is also there is something called as real discounting rate and nominal discounting rate also. Okay, are you all with me? So real cash flow discounted into real discounting rate, you will get one NPV, that is correct. Or nominal cash flow discounted with nominal discounting rate, you will get the NPV. Both the NPV will be same only. Are you all with me? If nothing is given, assume that real discounting rate only is usually. If nothing is given, assume everything is real. If in the question they says that nominal cash flow is equal to blah blah and inflation rate is this, then convert nominal into inflation. Nominal into 1 plus inflation is equal to real cash flows, and that real cash flows you discount and calculate the NPV. Okay. So how to calculate nominal discounting rate, sir? If at all in the MCQ they can ask. So nominal discounting rate is nothing but 1 plus real discounting rate into 1 plus inflation rate minus 1. Simple. Why? Because a real discounting rate will be actually more and nominal discounting rate will be less. Okay, so how to calculate? Okay, nominal discounting rate is 1 plus real discounting rate into 1 plus inflation rate minus 1. Okay, so capital rationing decision, once we come to the problem we will discuss. So till now, okay, till now you all have gotten clarity. Okay, you all have gotten clarity for investment decision. Now let us jump on to the fourth problem. It is a slightly big problem, but I will solve only 1 or 2 parts. So a machine used on a production line must be replaced at least every 4 years. There is a machine that we have to replace every 4 years. The cost incurred in the running machine according to its age are, sir, 0th year purchasing 3,000 rupees, sir. My maintenance cost, my first year maintenance cost is 800. My second year maintenance cost is 900. My third year maintenance cost is 1000. My fourth year maintenance cost is 1000. Sir, repair cost, sir. First year no repair required. But second year 200 rupees required for repair. 400 rupees required for repair in the third year and 800 rupees repair required for fourth year. So net realizable value. If at all I am selling it in the first year, I will get 1600 rupees. If at all I am selling in the second year, I will get 1200 rupees. If at all I am selling in the third year, 800 rupees. If at all I am selling in the fourth year, then 400 rupees I will get. So future replacement will be identical machine with the same cost. Revenue is unaffected by the age of the machine. Assume there is no inflation and as ignore tax. Cost of capital is 15%. So 15% is the discounting rate. Okay, so 15% is the discounting rate. Okay, this is what is the, and this is the present value annuity factor. Okay, determine the optimum replacement cycle. Okay, determine the optimum replacement cycle, which means, sir, should I replace in the first year? Should I replace in the second year? Should I replace in the third year? Or should I replace in the fourth year? That is what is the decision that you have to take. Sir, how to take a decision? Calculate what is the NPV from replacing in the first year? What is the NPV from replacing in the second year? What is the NPV from replacing in the third year? What is the NPV from replacing for the fourth year? But sir, how should I compare? Sir, this is 1 year NPV, this is 2 year NPV, this is 3 year NPV, this is 4 year NPV. Sir, life are different. First you are seeing for 1 year project. Second, you are saying if I'm using it for 2 years, what is the NPV? If I'm using it for 3 years, what is the NPV? Then what you do? Divide it by present value annuity factor to calculate something called as EAC, because it is a maintenance outflow. So equivalent annualized cost. And then wherever the EAC is lesser, that is the decision that you have to take within, which means in how many years I have to replace. Clarity. So let us solve this problem. Solution to problem number 4. Okay, replacing in year 1. If I am replacing in year 1, sir, what will happen, sir? What will happen? Year and cash flow. Sir, year 0, I am purchasing it for 3000 rupees, sir. Okay, I am purchasing it for 3000 rupees. Year 1, I am spending how much? 800 rupees. Year 1, I am spending 800 rupees. So again it is a spending, so outflow. Okay, sir, year 1 itself I am selling, sir. I don't need any. Every year I will purchase and sell new machine. So year 1 itself I am selling. So what is my realizable value? 1600. Okay, what is my realizable value? 1600. Inflow. Sir, it is a loss only, na sir. 3000 rupees you are purchasing, sir. 1 year value itself is half. Same thing only now. Whenever you are purchasing a car for 10 lakh, 1 year you use and sell, you will not even get 5 lakh rupees. That is what is same thing. Okay, year 0 3000, 1 you are spending 8000 for repairs, and then at the end of 1 year you will get 1600. Sir, present value factor at what rate? At 15 percentage. Okay, at 15 percentage. So 1, what is my discounted cash flow? This is 3000. Sir, 15 percentage present value factor 0.8696. Okay, 0.8696, 0.8696, 0.8696. Okay, so 0.8696 into 800 is how much? 695.68, and into 1600, this is an outflow, and then 1391.36. so minus 695.68 minus 3000 rupees, you are having an NPV of 2304.32. okay, this is what is the NPV, 2304.32 outflow. Sir, what if I am replacing in year 2? Sir, year cash flow, present value factor at the rate 15 percentage, and then discounted cash flow. Sir, year 0 I have to spend 3000 rupees. Year 1 I have to spend 800. Sir, year 2, because second year also I am using right now, so I have to spend 900 plus 200, 1100 rupees I have to spend, sir. Correct. And year 2 only I am selling, so I will get 1200 rupees as my realizable value. 1200 rupees is my realizable value. Sir, which means what, sir? 1. So this becomes 0.8696. Second one, it is 0.7561. 0.7561, 0.7561. Sir, which means 3000 you are spending here. Sir, 800 means 695.68 you are spending, sir. Next one, 1100 into 0.7561, which is nothing but 831.71. One more cost. Now 1200 into 0.7561. Sir, 907.32, and this is the NPV. Okay, this is the NPV. So 907.32 minus 831.71 minus 695.68 minus 3000, you will get negative 3620.07. Are you all with me? 3260.07. This much clarity you are having? Okay, same way you have to do. Okay, same way you have to do if I'm replacing in year 3. Replacing in year 3. Year cash flow, present value factor at the rate 15 percentage, and discount cash flow. Sir, year 0 I have to spend 3000 rupees. Year 1 I have to spend 800 rupees. Year 2 I have to spend 1100 rupees. Sir, again year 3 I have to spend how much, sir? 1000 for maintenance and 400 for repair. So 1400 rupees I have to spend. And year 3 I am selling. So I will sell at 800 rupees. Okay, I will sell at 800 rupees. Are you having this clarity? So this becomes 1.8696, 0.8696, 0.7561, and then 0.6575. okay, 0.6575, 0.6575. Okay, 0.6575 into 800 is 526 into 1400 is 920.5. 1100 I ordered 831.71, 831.71, 695.68, and then this becomes 3000. Sir, now what is my NPV? What is my NPV from replacing every 3 year? I will get 3695.68, 831.71, 920.5. It is 4921.81, 4921.89. Now you guys will be thinking, sir, every year my cost is increasing only. No, the question is not yet over. So now if I'm replacing in year 4, what will happen, sir? Which means I'm using the machine for full years, sir. All the years I'm using the machine. Replacing in year 4. So year cash flow, present value factor at the rate 15% and then discounted cash flow. Sir, year 0, spending 3000 rupees. Year 1, spending 800 rupees. Year 2, spending 1100 rupees. Year 3, spending 1400 rupees. Sir, year 4, again 1800 rupees I have to spend, sir. 1800 rupees I have to spend. Now year 4 I am selling. So what is my realizable value? Again half, 400 rupees is my realizable value. Okay, so this becomes 1. So 0.8696, 0.7561, 0.6575, and then 0.5718, 0.5718, 0.5718. Okay, so 0.5718 multiply by 400. How much you are getting? 228.72. 1800 you are getting 1029.24. This 1400 you already calculated, 920.5, 831.71, 695.68, and then 3000. Okay, so now you have to see what is the NPV. Sir, 3000 plus 695.68 plus 831.71 plus 920.5 plus 1029.24 minus 228.72. How much you are getting? You are getting 6248.41. Sir, wherever the NPV is the outflow, so wherever the outflow is lower, that is the best thing, sir. So replace every year. No. Now this is for a life of 1 year, this is for a life of 2 years, this is for a life of 3 years, and this is for a life of 4 years. How you can compare different year NPV? You cannot compare. So whenever there is a disparity in life, you have to calculate something called as EAC. Are you all with me? So what is the EAC, sir? The EAC is NPV divided by present value annuity factor. So here the EAC will be same, 2304.32. Why, sir? 1 year annuity factor will also be 1 only now. Sir, here what is the EAC, sir? Your EAC is equal to NPV. So 3620.07 divided by what is the present value annuity factor? 1.6257. So 1.6257. You should not do divided by 2. Okay, sir, 2 years NPV divide by 2, 1 year NPV. No, divide by present value annuity factor. 3620.07 divided by 1.6257, which is coming to 2226.78. Sir, what is my EAC here, sir? My EAC is 4921.89 divided by present value annuity factor for 3 years, 2.2832, 2.2832, which is nothing but 4921.89 divided by 2.2832, which is coming to how much? 2155 point, okay, 698 or 70. So next one here, EAC is equal to 6248.41 divided by present value identifier for a 2.8550. So 2.8550. So 6248.41 divided by 2.8550, which is coming to 2188.58. Now see sir, all these are NPV. Now all these NPV are comparable. 23404, 2226, 2155 and 2188. Which is lower? Sir, 2155 is lower. So it is advisable to replace in year 3. Okay. So since EAC is lower, don't see sir wherever is NPV is higher. No, this is cost. So cost means lower. Another I'm putting it negative. So since the EAC is lower in replacing in year 3, it is advisable to replace every 3 years. Are you all with me? So the meaning is that don't use the asset for full 4 years. You use the asset only for 3 years and replace, because 4th year I am getting only condemned value. So that is the reason it is lower. Okay, but 3rd year I'm at least getting some considerable amount. So it is better to replace in the 3rd year. So this is what is the solution to question number 4, right? So solution to question number 4. So this is how you have to solve the problem. Are you all with me? Super excited? Hello? See, I want your excitement also. Okay, I want your excitement also. And if you have time, which means if you're not watching it before the examination, solve it with me. I mean, if you're watching 1 week before the examination, it is better to spend 1 day to solve some 50 problems. See, all are very good problems that I have selected. Hand-picked problems and comprehensive problems, and all the concepts I've touched. See, this is a standard NPV problem. Second one is an IRR problem where the concept of equity IRR also have included. Okay. Third one is a more comprehensive problem where more adjustments are there, which means it is a full-fledged problem where the working capital adjustment is there, the depreciation and tax adjustment is there, one more equipment depreciation is there, additional depreciation. Okay, and also lot of common mistakes that people make, that is also there. Then fourth problem is a replacement decision problem, and it is also one of a kind problem. Okay, so one replacement decision problem. Now let us jump on to the next question number 5. Sir, now question number 5, a little bit big problem it is. Okay, little big problem it is, but don't worry, we will solve this problem. Okay, a product is currently manufactured on a machine that is not fully depreciated for tax purpose and has a book value of 70,000. So whenever book value of 70,000 is given, it means that tax impact on scrap value adjustment is there. So which means tax on capital gain or capital loss will be there. It was purchased for 2,10,000 20 years ago. Irrelevant information, but still we'll consider it. The cost of the product are as follows. I have to spend direct labor 28 rupees, indirect labor 14 rupees, other variable overheads of 10.5 rupees, fixed overhead of 17.5 rupees. Wait. I think it should be sale of 28, right? Mm-hmm. 14 plus 21 plus 7 plus 22.75 is equal to 64.75, which means 28 plus 14 plus 10.5 plus 17.5 is equal to 70. Actually this should be 70. Okay, this should be 70. Okay, so next one. In the past year 10,000 units were produced. It is expected that will suitable repairs the old machine can be used indefinitely in future. So if I'm repairing, I can use the old machine in the future also. The repairs are expected to average of 75,000 per year. So if I'm spending every year 75,000, I can use for next years also. Okay. An equipment manufacturer has offered to accept old machine as a trade-in for a new equipment. So old machine I can trade in for a new equipment. The new machine would cost 4,20,000 before allowing for rupees 1,05,000 for the old machine. Okay, so the new machine would cost me 4,20,000 and this 4,20,000 is before allowing for 1,05,000. So he is giving me 1,05,000 rupees of the value for the old machinery. So book value itself is 70,000 and he is paying me how much? 1,05,000 rupees. Okay, he is paying me 1,05,000 rupees. Okay, he is paying me 1,05,000 rupees. So 4,20,000 is a new machine cost, and from this cost I am giving him old machine and he is paying me back 1,05,000 rupees. So net cash outflow is 4,20,000 minus 1,05,000 rupees. This much clarity you are having? Super. The project cost associated with the new machine. Now whenever I am using new machine, my labor cost is reducing. Probably I don't need much labor now, but my indirect labor is increasing. Probably I need more supervisors now. My other variable overhead is reducing and my fixed overhead is increasing. Okay, my fixed overhead is increasing. The fixed overhead costs are allocation for other departments plus the depreciation of the equipment. So what they are trying to tell is that this fixed overhead is nothing but allocated fixed overheads. Always know that allocated fixed overheads are irrelevant, because allocated fixed overheads with what? Somewhere we are spending the fixed overheads that you are dividing it here. So it is just absorption. So absorption of fixed overheads is irrelevant. That is one thing that you have to consider. But depreciation is relevant. Why? Because depreciation is indirectly affecting my cash flow, but absorption is not affecting my cash flow. The old machine can be sold now for rupees 50,000 in the open market. Okay, the old machine can be sold now for 50,000 in the open market. The new machine has an expected life of 10 years and salvage value of 20,000 at the time. Okay, 20,000 at that time. The current corporate income tax rate is assumed to be 50%. So 50% is the tax rate. For tax purposes, cost of new machine and book value of old machine may be depreciated in 10 years. The minimum required return is 10%. Okay, the minimum required return is 10%. What is this 10% discounting rate? It is expected that the future demand of the product will stay at 10,000 units per year. So now also 10,000, future also 10,000. So no change in the number of units. If at all number of units are changing because of new machine, I can generate more number of units now. That will also form part of incremental cash flow. But now that is not forming. The present value of 10th year at 10% discounting factor is 0.386. Should the new equipment be purchased or not? Clarity, replacement decision problem. Always understand. Question number 5. Okay. So solution to question number 5. Always in replacement decision problems, stick to the format that I have given. Sir, first part, calculation of initial cash flow, or I will directly write it as initial cash flow. Sir, what is the initial cash flow? First, sir, first sale of old machinery. When I'm selling the old machine, how much I'm getting? I'm actually getting 1,05,000 cash. I should only consider cash. Okay, don't see book value and all. Cash. I'm getting 1,05,000 rupees. Okay, so how much I'm getting? 1,05,000 rupees. Now, whenever you're selling, See if the book value is given or not. If the book value is given, then you have to see whether it is a profit or loss. Sir, 70,000 is the book value and sale value is 1,05,000 rupees. Profit or loss? It is a profit. 35,000 profit. So whenever there is a profit, it means it is a capital gain. Whenever it is a capital gain, it means it is a tax expense. Okay. So now I have to reduce tax expense on capital gain because of profit on sale of equipment. Okay. So how much is the profit? 1,05,000 minus 70,000. 35,000 is the profit. Now on this profit I have to pay 50% tax. Correct. Because whenever I'm earning profit, I have to pay tax. So tax is an outflow. So 0th year I am paying the tax. Okay, 0th year I am paying the tax. Because that tax will go off. So now 1,05,000 minus 70,000, 35,000 into 50%. 35,000 into 50% is 17,500 rupees. See, if the examiner is a sadist person, what he will do? He will tell that the tax expense or benefit will occur in the first year, because 0th year how they will tax? Now only you sold, now only you will pay tax. Or no, you will pay tax in the next year. So what will happen? This tax expense alone you have to take it in the first year, if at all. Okay, like that comes. Mostly it will not come. Some complication, or if they want to make the question paper little bit more tougher, they can do these things. Okay, sir, sale of old equipment is done. Next, what, sir? Purchase of new equipment. Sir, purchase of new equipment. How much I am paying for the purchase, sir? I am paying 4,20,000 for the purchase. Correct. This is before allowing. So which means 4,20,000 I have to pay, and then I will get 1,05,000 rupees. If the word says after allowing, that which means this 4,20,000 is including the exchange value. Understanding? So now this is not. So 4,20,000 I have to pay. Now see, basically what is happening? I will pay 4,20,000 rupees. I will get 1,05,000 rupees because of exchange offer, and then I will pay tax of 17,500 rupees. So my net investment is 2,97,500. Correct. 2,97,500. This is what is my initial cash flow. Wait, let me just check. 4,20,000 plus 17,500 minus 3,32,500. Really sorry. Minus, okay, minus the tax I have to minus. So which is coming to how much? 3,32,500. 3,32,500. So this is what is the initial cash flow. My cash outflow, initial cash outflow. So which means what happening? I will receive 1,05,000 and then I will pay 4,20,000. So 3,15,000 I have to pay, and I have to pay one more 17,500 taxes. So net 3,32,500 rupees I have to pay. So this is what is my initial cash flow. Are you all with me? Now next one, sir, step 2, calculation of annual cash flows. Okay, calculation of annual cash flows. Sir, now what is happening in the annual cash flows? Just see. Sir, my labor cost was 28. Now my labor cost is becoming 14. So is there a savings in cost? Yes. So incremental savings. Incremental savings in labor cost. Sir, this is per unit cost, right? So on 10,000 units, I'm saving how much? 14 is becoming, so 14 rupees I'm saving. Okay, so into 14. So 14 into 10,000 is equal to 1,00,000 40,000. Okay, so 1,40,000. Sir, inflow or outflow? Inflow. Sir, labor cost only na. Sir, you're paying na? No pa. Savings means inflow. Correct. An additional, which means it is an outflow. So incremental savings. I'm saving 1,40,000 rupees. So indirect labor increase in, okay. So incremental increase in indirect labor. Okay. So increase in indirect labor. Increase in indirect labor. So on 10,000 units, how much is the increase? Okay, 14 is becoming 21. So which means 7 rupees is the increase. Are you all with me? So 7 rupees is the increase. Okay, 7 rupees is the increase. Okay. Or directly what you can do, fixed cost you have to avoid, right? So totally do this 3. Total these 3. What is the total of these 3? 28 plus 14 plus 10.5. 28 plus 14 plus 10.5. This is nothing but 52.50. And here what is the total? 14 plus 21 plus 7. 42 rupees. So net savings you can put. Either plus or minus you do, you will get same thing only. So let me just do it in this way. So for that, so what is my increase? 7 rupees increase. Sorry, what is my increase in cost? 14 is becoming 21, correct? So 14 is becoming 21 means 7 rupees increase in cost. So it means 70,000 rupees is my increase in cost. So next one, what is happening? Other variable overheads increasing or decreasing? Decreasing. So it means it is a savings. Okay, so it is what? Savings. Savings in what? Other variable overheads. Savings in other variable overheads. So 10,000 into what is my savings, sir? Previously it was 10.5, now it is 7. So 3.5 rupees savings I'm having, correct? So into 3.5, so that is coming to 35,000, correct? 35,000. So this is nothing but incremental savings in total variable cost. So how much is my incremental savings? 1,40,000 plus 35,000 minus 70,000. It is coming to 1,05,000. Clarity. Same 1,05,000. How you can calculate? Sir, 52.5 is my old variable cost. 42 is my new variable cost. So 52.5 minus 42 is coming to 10.5. 10.5 into 10,000 units, you will get 1,05,000. Same 1,05,000 you can calculate like that. That is an easy method, but just for an explanation I'm giving you this. This method you cannot follow if the number of units are changing. So if the number of units are changing, how you have to do? First you have to calculate what is the original labor cost, then what is the new labor cost, then incremental labor cost. So you have to do 2 tables like this. Okay, what is the existing? Okay, what is the existing? Then what is the new? And then what is the incremental? Like that 3 table you have to draw if number of units are changing. This much clarity you are having? Okay. Now let us go on to the next one. Sir, annual cash flow. Sir, incremental savings in variable cost. Now what next, sir? There is also savings in repair. Understanding, sir? Previously I were to spend 75,000 per year for repair. Now I will not spend. So it is a savings. Correct. So savings in repair cost. Because when I'm purchasing new machine, 75,000 I'm saving. Otherwise I should have spent 75,000 rupees. This much clarity you're having. Super. Sir, incremental depreciation. Sir, 20 years ago I purchased 2,10,000 rupees, sir. Okay. Now see, 2,10,000 20 years ago. Okay, 2,10,000 20 years ago, and now my book value is 70,000. So what I will do to 2,10,000 minus 70,000, 1,40,000 is the depreciation that I have charged in 20 years. So divided by 20, every year I am charging 7,000 depreciation. Okay, every year I am charging 7,000 depreciation. Are you all with me? So previously I was charging 7,000 depreciation every year. This much clarity you are having, sir? How you have calculated 7,000? Again, can you tell me? Yes, pa. See, 20 years ago I purchased 2,10,000. Okay, 2,10,000. 20 years ago I purchased. Are you all with me? Okay, sir. Which means what, sir? Now I will be using the machine for next 10 years. So divide by 30 panna, directly you will get 7,000. But that is not the correct way. Probably there may be some enhancement in years. So how you have to do? How much depreciation already charged? 2,10,000 I have purchased it 20 years ago. Currently book value is 70,000, which means that 1,40,000 rupees I have charged total depreciation in last 20 years. Because it is SLM, every year I will be saving the change thing, same thing. So 1,40,000 divided by 20, if you do, you will get 7,000 rupees is the depreciation. Sir, now what will be the new depreciation that I will be charged, sir? Now 10 years, correct? So 10 years. What is the cost of my new machine? 4,20,000. So 4,20,000 divided by 10 is how much? But salvage value is also there, right? So 4,20,000 minus 20,000, 4 lakh divided by 10 years. How much I'm getting? 40,000. So which means, sir, 33,000 extra depreciation you are charging. Clarity, sir. I'm not getting clarity, sir. I will write it down. You will get clarity. Sir, next one, what I have to do? I have to less incremental depreciation. Sir, what is incremental depreciation, sir? What is the depreciation that I'm charging now? Sir, now I'm charging, sir. Now I'm charging depreciation. What is the cost of the new machine? 4,20,000. What is the salvage value? 20,000. For how many years I will be using the machine? 10. This is my new depreciation. Sir, what was my old depreciation, sir? My old depreciation was, I have used, okay, 20 years ago I purchased for 2,10,000. 20 years ago I purchased for 2,10,000. Now it is 70,000. So this is my total depreciation that I have already charged for 20,000. Actually, I should not put it in this way. You will get confused. Directly you will put minus 7,000 because I am charging 7,000 depreciation every year. Clarity. So that is what is the incremental depreciation. So which is coming to 33,000. This much clarity you are having. Sir, what, sir? Which is nothing but 40,000 minus 7,000. Sir, how, sir? New machine, if I am purchasing every year 44,000 depreciation I am getting. How, sir? 4,20,000 minus 20,000, 4 lakhs divided by 10 is equal to 40,000. Sir, old machine I was charging every year 7,000 depreciation, sir. Why? Because so long back I have purchased it and till now I am using it. Okay, so 7,000 is a depreciation. This much clarity you are having. Okay. So incremental depreciation. So now I will be getting incremental profit before taxes. Okay. So incremental profit before taxes. How much? 1,05,000 plus 75,000, 1,80,000. 1,80,000 minus 33,000 is 1,47,000. Okay. So 1,47,000. Sir, minus tax. Tax is at the what rate? Tax is at the rate of 50%. Okay, so minus tax at the rate of 50%. So what is 1,47,000 into 50%? 73,500. Sir, what is incremental profit after taxes? 73,500 plus, sir, incremental depreciation. How much depreciation I have reduced? 33,000. So this is the incremental cash flow after taxes. Sir, 73,500 plus 33,000, how much, sir? 1,06,500 is my incremental cash flow after taxes for 1 to 10 years. This much clarity are you all having this? Okay, sir, next one. Third one, come, terminal cash flow. Third one, terminal cash flow. Now, sir, there was no salvage value for the old machine. So what is the salvage value for the new machine? No incremental because no salvage value was there for the old machine. So what is my salvage value for the new machine? 20,000. Okay, salvage value for the new machine is 20,000. Is there anything else given? Working capital, nothing is there. Okay, that is what is the question. Sir, why this open market value is given, sir? Now you check one thing here. My book value was 70,000. In the open market, I can sell it as 50,000 rupees. But I have actually received more than open market value only. 1,05,000 rupees. So that is the reason I will consider 1,05,000 rupees as a cash inflow in the initial cash flow. Suppose my open market value is 1,20,000 rupees, but that guy is giving me only 1,05,000 rupees. So he's telling, hey, if you want to purchase new machine, I will give you only 1,05,000 rupees. So because I wanted new machine, I just went on and purchased it. But this extra 15,000 is also your opportunity cost, right? Had I sold in open market value, I would have received 1,20,000 rupees. So I'm making an opportunity loss of 15,000 rupees. That also you have to consider in the initial cash flow. Initial cash flow, you have to minus 15,000 rupees, which is nothing but the opportunity lost or opportunity cost. Because open market value, had you sent, you would have spent 1,20,000 rupees, but now you're getting 1,05,000 rupees. So that is the reason you have to spend. Sir, why not you're considering opportunity benefit? No. Conservatism. You're getting 1,05,000 rupees, that is your inflow. That's it. There is no opportunity benefit cost of concept here. Clarity? Hello? Okay. So if the examiner is a sadist person like me, he will put the open market value more. But you will ignore, like how we ignored in this problem. But you didn't know how to ignore. So ignoring is also a very big task. Okay, but ignoring was also a very big task. You have to give reasons why you're ignoring something. Okay, so this is done. Now you have everything done. So this is what is the terminal cash flow. Wait, terminal cash flow is over. Now calculation of NPV. Okay, now calculation of NPV. Sir, year cash flow, present value factor at what rate? At what rate? The question says present value factor at 10%, right? Or 10%. So at 10% and then discount cash flow. Sir, 0th year, what is my initial cash flow? 3,32,500. Okay, 3,32,500. Sir, 1 to 10 years, what is my annual cash inflow, sir? 1,06,500. Actually, it says that positive only NPV because now itself I am getting to know. And 10th year, what is my inflow? 20,000 rupees. Sir, 1. So 3,32,500. 1 to 10 year, what is my present value annuity factor? So what I have to do? 1 divided by 1.1 equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It is 1 divided by 1. It is 6.145. Correct? 1 to 10 only, na? 1 divided by 1.1. 2, 3, 4, 5, 6, 7, 8, 9, 10. So 6.145 or 1446, whatever be the case. 1446. And then 10th year it is given, so I will take it from here. 0.386. That I will take it from here. 0.386. 0.386. Sir, 0.386 multiplied by 20,000 is equal to 7720. Sir, 6.1446 multiplied by 1,06,500 is equal to 6,54,400, sir. Which means, what is my NPV? 6,54,400 plus 7720 minus 3,32,500. So I'm getting 3,29,620. So 3,29,620 is the NPV which is positive. So since NPV is positive, it is advisable. It is advisable to replace the old machinery. Are you all having this clarity? Okay. Always use this word. It is advisable. Don't put NPV is positive, replace. Like that, if you write now, ego issues will come. Hey, what? You are asking me to replace? Who are you? CMA Final student. You are asking me to replace? Go, I will not give marks. Okay, so don't put it. You just tell it very humbly. It is advisable. If you want to do it, if you don't want to, don't do it. Okay, so since NPV is positive, it is advisable to replace the old machinery. So that is what is the answer. And also, though they have asked, should the equipment is purchased? Should the new equipment is purchased? Don't write yes. Like that, don't write. It is advisable to replace. Like that, some humble sentences and all you have to write. Are you all with me? Hello? Okay. Now, sir, question number 6. Question number 6, if you see, it is a capital rationing problem. Okay, question number 6 is a capital rationing problem. So let us go here, sir. Capital rationing problem, how you have to see, sir? You have to do the ranking based on the profitability index. Sir, when we have to choose multiple projects with limited capital, only then capital rationing decision will come. Then we have to do ranking of the project. Sir, ranking shall be on what? On profitability index, not on NPV. Sir, if my projects are divisible, so what I can do? I will rank on the basis of profitability index, and last how much ever is remaining, proportionally I will invest in the next rank. Proportionally allocate in the next ranking project. Sir, if the project are not divisible, it means what, sir? Combination of project, wherever is the highest NPV you select. Not divisible means you cannot break the project. Padi I will invest here. You cannot do that. So combination of project, wherever the NPV is higher, that you have to do. Okay. So when synergy is given, that also you have to consider, which means if you are investing in project A and B both, your investment is reduced. If you are investing in project B and C or both, your cash inflows are increased. So like that, if something is given, you have to consider that also. Okay. So this is what is capital rationing. Sir, let us see the problem. Question number 6. Solution to question number 6. Sir, now solution to question number 6, sir. 5 projects M and O, P and Q are available to a company for consideration. The investment required for each product and the cash flows it yield are tabulated below. Projects N and Q are mutually exclusive. Taking the cost of capital at 10%, which combination of projects should be taken up for a total capital outlay not exceeding 3 lakhs? Okay, not exceeding 3 lakhs. So this is what is the problem. Okay, this is what is the problem, which is a capital rationing problem, sir. Okay, it is a capital rationing problem. Sir, how to see, sir, whether the project are divisible or indivisible? How we have to assume, sir, whether it is given in the problem? See, N and Q are mutually exclusive. It means what? If N is taken, Q cannot be taken. If Q is taken, N cannot be taken. So both are mutually exclusive. Okay, both are mutually exclusive. Okay. If N is taken, Q cannot be taken. If Q is taken, N cannot be taken. Okay. So for how to do, sir? First calculate profitability index. Sir, what is profitability index? A discounted cash inflow divided by discounted cash outflow. Sir, this investment is nothing but discounted cash outflow. Sir, now I have to calculate discounted cash inflow, sir. I will solve it here only. Sir, discounted cash inflow. How to do? So discounted cash inflow is nothing but cash flow into present value annuity factor, which means 18,000 into 6.145. Correct? 18,000 into 6.145. So you will get how much? 18,000 into 6.145. You will get 1,10,610. Okay. So 1,10,610. So likewise you have to do. Okay. Likewise you have to do. Appa sir, first what, sir? First you have to calculate something called as discount cash inflow and discount cash outflow. So sir next one sir C krama panla. Okay, project M N O P and Q. Sir, cash flow per annum, it is given how much? 18,000, 50,000, 30,000, 40,000 and 30,000. Sir, cash flow per annum, done. Sir, next what, sir? Present value annuity factor is also given at the rate 10%. Okay. At the rate 10%. It is directly given. No need to write years present value. So 6.145, 3.170, 5.335, 7.824 and then 9.077. This is what is the values. Now what I have to do, sir? I have to multiply everything so that I will get discounted cash inflows, which is nothing but cash flow into present value annuity factor. Understanding about what is 18,000 into 6.145? 1,10,610. Okay, 1,10,610. About what is 50,000 into 3.17? 1,58,500. 1,60,050. 3,12,960 and then 2,72,310. So 3,12,960. Sir, what is my discounted cash outflow? It is also called as initial cash flow. Already given in the question, correct? 50,000, 1 lakh, 1,20,000, 1,50,000 and then 2 lakh. If you minus, you will get NPV. If you divide, you will get profitability index. Are they asking NPV? You also calculate NPV. So on the basis of NPV and on the basis of BCR. Okay. On the basis of NPV and on the basis of BC. Okay, on the basis of this. Okay, sir. Now next one. About what you have to do? You have to calculate both. You also have to calculate NPV and you also have to calculate profitability index, or it is also called as benefit cost ratio. Sir, what is NPV? 1,10,610 minus 50,000. It is how much? 60,160, right? This is 58,500. This is 40,050. This is 1,62,690 and this is 72,310. What is my profitability index? 2.212, 1.585, 1.334, 2.086 and then 1.362. Sir, now they're asking ranking on the basis of NPV and ranking on the basis of profitability index also. Okay, so what you have to do, sir? First one, okay, first one you just have to do rank. Okay, first one you just have to do rank. What is the ranking on the basis of NPV and what is the ranking on the basis of profitability index? Sir, what is the ranking, sir? Pakala or rank, you just put one rank. Sir, this is first rank, first based on profitability index. This is second rank. Then 1.5 third rank, 1.36 fourth rank and then fifth rank. Okay, so 1, 3, 5, 2, 4 is on the basis of profitability index. So on the basis of NPV, project P is first rank. Okay, project P is first rank. This is second rank, third rank, fourth rank and then fifth rank. Sir, first next what I have to do, sir? Next what I have to do? What is my total investment? What is my total investment? 3 lakh rupees, right? Now this 3 lakh rupees I can invest in where and where? Sir, this 3 lakh rupees I can invest in N and Q. And some two things are mutually exclusive. What are those two things? N and Q are mutually exclusive. So which means N and Q I cannot do together. N and Q break up. Wherever N is there, Q will not come. Wherever Q is there, N will not come. Clarity? Okay. So now what are the combinations in which I can do, pa? First mention the combination where my investment should not exceed 3 lakhs. So now what, sir? This 1 lakh 20, 2 lakh 20, 2 lakh 70,000. So M, N and O. How much is the investment? 2 lakh 70,000. Okay, M, N and O. So next one I can take M, N and P. M, N and O reduce பண்ணிட்டு I will take P. So 50, 1 lakh 50 and 3 lakh. So because it is exactly coming to 3 lakh. Next what, sir? Q and P I cannot take. Q and O I cannot take. Q and N I can take. Q and N I can take. No. N and Q are already breakup. So Q and M. So MQ. MQ is 2 lakh 50,000. Okay. M and Q is 2 lakh 50,000. Okay. 2 lakh 50,000. So next what? Sir, M and Q is okay. Next with N I will see. N and O 2 lakh 20,000. Okay. So N and O 2 lakh 20,000. It is very less. Probably I will check. Wait. N and Q are mutually exclusive, right? Okay. M and N and O I cannot take. M and O is over. M and P is over. M and Q I cannot take. So NOP cannot because more than 3 lakh. NOQ more than 3 lakh. NOM is already done. OP 2 lakh 70,000. Okay, let me take OP 2 lakh 70,000. Okay, OP 2 lakh 70,000. OQ I cannot take because it is 3 lakh 20,000. PQ 3 lakh 50,000 I cannot take. QM 2 lakh 50,000. Okay, already done. NQ I cannot take. OQ 3 lakh 20,000 I cannot take. So basically this is something that I'm getting. Okay, OP, MQ, MNP, MNO, NNP also I can take 2 lakh 50,000. Clarity. Now for all this investment I have to calculate the NPV. For all this investment I have to calculate the NPV. Sir, M, N and O, what is the total of the NPV? Okay. Sir, M is 60,160. N is 58,500. And O is 40,050. So M and O I'm getting 158,710. Okay. 158,710, correct? 60,160 plus 58,500 plus 40. So 158,710. Sir, M and P 60,160, 58,500, P 162, 690, which is coming to 2,81,350. See, basically you have to go from the ranking. Okay, basically you have to go from the ranking, from the profitability index. So first take M, then take P, and then take N. So M, N and P will be the highest. There is no chance because you are taking all the three. So basically the answer itself is 1. But they are asking ranking. They are not asking which combination you have to select. If the answer is combination, the answer is M and P. I know. Okay. Sir, next one, M and Q. What is the NPV for M? 60, 160. For Q, 7231. So 1,32,470. O and P, 4 and then 162,690. 2,02,740. Sir, N and P, 58,500 plus 162,690. It is coming to 2,21,190. Now do the ranking. Okay, now do the ranking. So the ranking is, this is first, this is second, this is third, this is fourth, and this is fifth. Okay, so this is how you have to do. Okay, this is how you have to do. Are you all with me? Okay. So M and P will be the first rank. NP will be the second rank. OP will be the third rank. MNO will be the fourth rank. And MQ will be the fifth rank. Okay, so this is how you have to do this. Okay, this is how you have to do this. So on the basis of NPV. This much clarity you are having? Hello? Super. But they have also asked ranking on the basis of profitability index also. So you can also calculate what is the profitability index of the combination and then do the ranking. Sir, how to do profitability index, sir? Which is nothing but this is discounted cash outflow and this is NPV. Actually, outflow plus NPV is inflow. Correct? Because inflow minus outflow is NPV. Inflow minus outflow is equal to NPV. So I want inflow. So inflow is nothing but outflow plus NPV. So basically what you have to do, 158,710 plus 2,70,000 divided by 2,70,000. 158,710 plus 2,70,000 divided by 2,70,000. You will get 1.589. Okay, 1.589. So this is what is the answer. Or else what you can do, directly you can do net profitability index. What is net profitability index? NPV by inflow. So 158,710 divided by 2,70,000. You will get 0.587. Do plus 1. You will get 1.589. So likewise, you just have to calculate profitability index and then you have to do the ranking. Okay, you have to do the ranking. So MNP, what is the profitability? 1.940. Okay, 1.940. MQ, it is 1.532. Okay, basically what you have to do, 2,81,350 divided by 3 lakh plus 1. You will get 1.938. Okay, 1.938 something you will get. So likewise you have to do 1.938. So likewise you have to calculate profitability index and then you have to do the ranking. So this is how you have to solve this problem. Are you all with me? So with this, the solution to question number 6 is also completed. It is a very good capital rationing problem. Are you all with me? Sir, next one. Again, this is a, okay, again, this is a problem. Pioneer Projects Limited is considering, okay, it is risk evaluation because probability is given. Sir, is considering accepting one of two mutually exclusive project X and Y. Okay, mutually exclusive project X and Y. The cash flows and probabilities are estimated as follows. So project X ke what are the cash flows and project Y ke what are the cash flows? It is given. They are just asking you to advise. See, first of all, like this blunt problem, they will not ask in the examination. But whenever like this, they're asking, you know that cash flows are given and probabilities are given. So what you can do with this, you can calculate something called as expected cash flow. Okay, so which is nothing but X dash and Y dash. So you can calculate X dash and then you can calculate Y dash. after x dash and y dash, that is what is the expected cash flow. So wherever the expected cash flow is more, that project you can select. That is number one. Or what you can do, you can also see the risk. Risk means what? Variance you can calculate. So variance you can calculate and see wherever the variance is more, or standard deviation. So wherever the standard deviation is more, that is risky. Okay, and wherever so wherever standard deviation is less, that you have to select, or wherever the expected cash flow is more, that you have to select. So that is what is the advice. So usually they will ask you advice on the basis of expected cash flow, or advice on the basis of risk of the cash flow, or advice on the basis of both. Both means what? Coefficient of variation you have to calculate. So what is coefficient of variations? It is nothing but standard deviation of project X divided by mean of X. Clarity. This is what is the coefficient of variation. So coefficient of variation means risk per return. Are you all with me? So what is the amount of risk that I am taking per, wait. X dash, sorry. X dash divided by standard deviation of X. See, Sharpe ratio is also the same. Sharpe ratio is reward to risk ratio, and opposite of Sharpe ratio is coefficient of variation. Basically both are inverse. Like that MCQ question can also be asked. Okay sir, so this is done. So if you want me to solve this problem, it is a very simple problem. Let me just see. So question number 7. Okay, question number 7. Okay, solution to question number 7. Okay sir, question number 7. How, sir? I have to calculate. Okay, how I have to calculate? First, X and cash flow both are given. So first you have to calculate P, okay, and X, then P and Y. Probability of Y is also given. Okay, so how you have to do, sir? I will just write it here. Okay, I will just write it here. So this problem I want you to solve. Okay, this problem I want you to solve, because simple calculation, probability P, then into cash flow, then P into X. The total of P into X is nothing but X dash. Clarity. Now what you have to do? X minus X dash. So whatever is there, X minus X dash. Then what you have to do? X minus X dash square into P. And this total is nothing but variance. Same thing do for Y. Problem done. Are you all with me? Problem done. Okay, same thing. Or let me do for X, you do for Y. Okay, let me do for X, you do for Y. So that you guys should be having some clarity. Sir, P, X, then P into X. What is the probability? 0.1, 0.2, 0.4, 0.2, and then 0.1. Okay, 0.1, 2, 4, 2, and 1. Then cash flow, I will put it in thousands, because when you're squaring, right, it will become very big number. So it is advisable to put it in thousands only. Okay, in thousands. So 12, 14, 16, 18, and then 20. Sir, what is 12 into 0.1? 1.2. This 2.8. This 6.4. This 3.6. And this will become 2. Sir, what is X dash? X dash is equal to 1.2 plus 2.8 plus it is equal to 16. Next, sir, X minus X dash. What is X minus X dash? 12 minus 16, which is minus 4. 14 minus 16, minus 2. 16 minus 16, 0. 18 minus 16, 2. 20 minus 16, 4. Now what, sir? X minus X dash, the whole square into P. Or no, a lot of people, what they will do, they will first do X minus X dash the whole square, then they will do it the next step into P. Why? One step extra. Some directly. 4 into 4, 16. So 16 into 0.1, 1.6. Okay, so like this you have to do 1.6. 2 into 2, 4. 4 into 0.2 is equal to 0.8. So this is 0, so this becomes 0. 2 into 2, 4. 4 into 0.2 is 0.8. 4 into 4, 16. 16 into 6.1 is 1.6. So what is the variance? This is what is the variance. My variance is 0.8, 1.6, 1.6 into 3 is equal to 4.8. Okay, so your variance is equal to 4.8. Are you all having this? So this is what is this. So what you have to do, you have to calculate something called as standard deviation. Standard deviation is root of 4.8. In advice they're asking, right? So coefficient of variation you have to calculate. So 4.8 you have to do 2.19. So 2.19 is the standard deviation. So coefficient of variation is equal to standard deviation divided by x dash, which is nothing but 2.19 divided by 16. Okay, so what is 2.19 divided by 16 into 100, which is nothing but 13.68 percentage. Now a lot of people will do a mistake. You will get coefficient of variation as 13.68 percentage here. Okay, 6875 percentage actually it is. Okay, 13.6875, so it is technically 69, so 6875 percentage. Same thing do for y, same thing do for y. Okay, p y, then p into y. Okay, p into y, if you do, you will get y dash, then y minus y dash, then y minus y dash the whole square into p, and this is nothing but delta y square. Okay, this is nothing but standard deviation of y square, the standard deviation of y square. Now once you do this, you will get your expected cash flow here as again 16. Opposite expected cash here is also 16, here is also 16, but see the variance here, the variance will be 20.8. 20.8 because the cash flows are more varying here, the cash flows are less varying here. So even though the expected cash flow is same, but the variance is more. So what you have to do, you have to calculate something called as coefficient of variance. So coefficient of variance is nothing but standard deviation, so root of 20.8. so 20.8 is equal to 4.56. so coefficient of variation is 4.56 divided by 16. So 4.56 divided by 16 into 100 is 28.5 percentage. Okay, 28.5 percentage. Okay, so 4.56 divided by 16, 28.5 percentage. Now a lot of people, what they will do, sir, coefficient of variation percentage is more, select y. No, coefficient of variation measures the risk. See, what is the formula? Risk by mean. So what is the risk per mean and what is the risk per mean? Understanding? So coefficient of variation, because what is in the numerator? Risk. So more percentage means more risk, ignore. So here what? Sir, here I am taking a risk of 20.8. Is it worth to take more risk? Yes, if you are getting more return. So return is same, sir. Apo here also 16 return, here also 16 return or cash flows. Apo it is better to earn this 16 with lesser risk, right? Why to same cash flow I have to earn for more risk? So for that only you have to calculate something called as coefficient of variation. So wherever the coefficient of variation is more, it means the project is more risky. This one line, lot of people will make a mistake. Okay, wow. So since coefficient of variation is more in project Y, it means Y is more risky. It is advisable to select Y. Okay, so project X is advisable to select. Clarity? So this is what is our advice. Blunt question. So, but a very conceptual question. Okay, question number 7 was a very conceptual question. Now, question number 8. Okay, now question number 8. Let us move on to the next question. Question number 8. Just one moment. Okay. Sir, A Limited has a choice between the three projects X, Y, and Z. The following information has been estimated. So, project X, Y, and Z, I am having three situations. Situation 1, situation 2, and situation 3. Situation 1 is having a probability of 0.6, so 60% probability, 20% probability, and then 20% probability. Which project should be undertaking if the decision is made by expected value approach? Sir, what is expected value approach? First is calculate something called as expected profit. Expected profit. So how to calculate expected profit? 190 into 0.6 plus 50 into 0.2 plus 15 into 0.2. Clarity. So 190 into 0.6 plus 50 into 0.2 plus 15 into 0.2. What? You are getting 127. Sir, 110 into 60, 200 into 20 and 160 into 20. How much? Sir, expected profit is equal to 138. Sir, 150 into 0.6, 140 into 0.2, 110 into 0.2. How much? Sir, 140. So since my expected value is more in project Z, I will go and I will select project Z. This is what is the answer. Clarity. Simple problem. Nothing great. Expected value. Sir, calculate the expected value in terms of perfect information. A lot of people will make a mistake. Sir, what is the meaning of perfect information? Which means the information is perfect. You know that exactly 60% probability will be there. So which means what, sir? Which means if the probability is 60%, which means if the probability is 60%, then what you will do? You will choose X. If the probability is 20%, you know, in the D2 scenario, okay, in the D2 scenario, what you will do? 190, right? So this is 190. In the D2 scenario, you will choose project Y. And the D3 scenario, you will choose project Z. Which means your cash flows will be 190 into 60% plus 200 into 20% plus 160 into 20%. Sir, perfectly I know, sir. So if then what is my expected value? Then this is the expected value. So 190 into 60%, 200 into 20%, and 160 into 20% is 186. Period. Done. Question number 8 is completed. Okay, question number 8 is completed. Are you all with me? 8. Solution to question number 8. Okay, same thing. Okay, same thing. I will just copy and paste here. Just one moment. Copy. Paste. Uh-oh. Only values are coming, pa. Wait 1 minute. Is there any snip possible? Okay, anyways, but I will just write, okay, I will just write A 140 and B 186, okay. A 140 and B 186. Okay, so you can solve this. Are you all with me? So this is what is the expected profit. So first one, which project I should select? 140, which means project Z I should select. 140 na I should select project Z. Answer is not expected value. Answer is which project you have to select. So you have to select project Z. So with this, question number 8 is also completed. Okay. Now let us move on to the next one. Question number 9. Sir, question number 9. M Limited is attempting to decide whether or not to invest in a project that requires an initial outlay of 4 lakhs. The cash flows of the project are known to be made up of two parts, one of which varies independently over time and other which display perfect positive correlation. So perfect positive correlation, definitely it will happen. It will increasing, it is also increase. So perfectly correlated and then independent component. The cash flows of the 6-year life of the project are given. Find out the expected value of NPV and its standard deviation using a discounting rate of 10%. Now, let us come back to the notes. Leasing, we will do it afterwards. Risk analysis in capital budgeting. Sir, in capital budgeting problem, expected future cash flows are calculated. Correct? You are estimating the future cash flows. When you are dealing with future numbers, always uncertainty and risk is there. How to handle the risk? That is what is given in risk analysis in capital budgeting. So you have certain methods: certainty equivalent, risk adjusted discounting rate, expected NPV and standard deviation, and decision tree analysis. So very important is expected NPV. This already has certain, a lot of questions are asked. Advanced techniques very rarely asked, but mostly the first 4 techniques are asked. Sir, what is certainty equivalent approach? Risky cash flows are given that are multiplied with coefficient. Some coefficient will be given to convert it into risk free. Suppose 10,000 is my cash flow. Certainty coefficient is 0.5. So 10,000 into 0.5, 5,000 is my risk free cash flow. So risky, I will convert it into risk free, and that risk free I will discount using a risk free rate. And that NPV is called a certainty equivalent approach. Clarity. So risky cash flow multiplied by certainty equivalent, I will get a risk free cash flow. Risk free cash flow discount using risk free rate. Very important. I will get discounted cash flow. Sir, what is risk adjusted discounting rate? Risk adjusted discounting rate means risk free rate plus premium for normal return plus premium for abnormal risk. So premium for normal risk and premium for abnormal risk, if you add these 3 components, you will get, which is nothing but risk free rate plus some premium. Both are premium. Okay, wow. Risk free rate plus premium. Sir, what is risk free rate plus premium for normal risk at the cost of capital? KE. KE plus some premium I want for abnormal. Something abnormal happened now, what? So plus some premium, and that is what is my discounting rate. So it is nothing but risky cash flow discounted using risk adjusted discounting rate is the discounted cash flow. Simple thing, nothing great. Okay, risk adjusted discounting rate. Usually you are using 12% KE as your discounting rate, right? They will tell that take 3% more as risk. So your discounting rate will become 15%, and this 15% is discounted. So that is what is risk adjusted discounting rate, nothing great. So what is expected cash flow? Cash flow into probability. See this question, cash flow into probability, that will come to expected cash flow. Then x minus x dash, then x minus x dash into probability, you will get the variance, and variance if you do root, you will get standard deviation. Sir, our expected cash flow is sigma x into p, and standard deviation is sigma x into x dash whole square into p the whole root. Okay, so likewise, this is 1 year cash flow. Year 1 has 5 probabilities. Likewise, year 1, year 2, year 3, year 4, year 5, all the probabilities cash flow you have to do. Now all expected cash flow you have. So calculate all the expected cash flow and discounted using discount and discounted. So that you will get discounted cash inflow. Then expected NPV is nothing but present value of expected cash flow minus discounted cash outflow. Okay, nothing great. Okay, this is nothing great. All the expected values that you have, right? These expected values you have to discount. So that is nothing but expected NPV. So how to calculate standard deviation of NPV? If the cash flows are perfectly correlated, then all the standard deviations discount per you will get NPV. So present value of standard deviation of cash flow is NPV. If the cash flows are uncorrelated, then nothing you have to do. That present value square per you just root it down. So square the present value of standard deviation, total it, and then do it a root. That is what is this. Okay. If they are moderately correlated, basically if they are moderately correlated, then what you have to do? That NPV, you have to calculate something called as expected NPV. So NPV minus expected NPV you do. Okay, NPV minus expected NPV you do the whole square and into root. So that is what is the standard deviation of NPV if it is moderately correlated. Sir, how to calculate NPV? NPV is nothing but the joint probability you have to multiply, similar to decision tree. And what is the coefficient of variation? Standard deviation of NPV divided by expected NPV. This is what sensitivity analysis is nothing but you have to calculate NPV using some 4 factors. You have to change one factor and keep all the 3 factors constant. For example, if they are asking calculate, do sensitivity analysis if all the variables are changed, affected by 10% adverse. So which means if my initial cash flow is increased by 10%, what will be the NPV? If my annual cash flow is decreased by 10%, what is? Because adverse na initial is increasing, annual inflow it is decreasing. If my life is increasing by 10%, what will be my what is my NPV? If my discounting rate is increasing by 10%, what is my sensitivity? So like that you have to calculate and see which factor is more sensitive. So that is what is sensitivity analysis. Clarity. Monte Carlo situation, Monte Carlo simulation, not very much asked in the examination, very rarely asked in the examination, and that only one problem is there in the study material. So it is nothing but all the factors are changing. So some random numbers you have to put, and that random numbers which you have to simulate and you have to calculate random NPVs. And based on that, you have to take the average. That is what is Monte Carlo simulation. Okay, Monte Carlo simulation. So this is what is risk analysis in capital budgeting. Okay. Sir, now let us go to question number 9. Question number 9. Find out the expected value of NPV and its standard deviation. So all are expected cash flow. This is also expected cash flow. This is also expected cash flow. But this is for perfectly correlated components and this is for independent components. Okay, this is for perfectly correlated components and this is for independent components. Basically, expected cash flow is nothing but perfectly correlated or independent, both should be added. That is what is the expected cash flow. So find out the expected value of NPV. So what you have to do, first to calculate the expected cash flows. Solution to question number 9. Sir, first one, what sir? I have to calculate the expected cash flow or expected NPV, correct? So expected NPV is nothing but expected cash flow. You have to discount. Sir, what is expected cash flow? Cash flow from perfectly correlated and cash flow from imperfectly correlated, both you have to add. So perfectly correlated and independent, both you have to add. Wait. Here I will put. Okay, here 1, 2, 3, 4, 5 and 6 years, right? So this is nothing but perfectly correlated and independent. Both if you add, you will get expected cash flow. Do present value at the rate 10%, you will get the discounted cash flows. Correct, you will get the discounted cash flows. And 10% is the discounting rate. Okay, so 40 plus 42, likewise you have to do. Okay, 40 plus 42, 50 plus 50, so 40,000, 50,000, 48,000, 48,000, 55,000, 60,000, 42,000. Very important. Okay, 50,000, 50,000, 50,000, 52,000, 52,000. Sir, what is my expected cash flow? Adding both. Both are expected cash flow. This perfectly correlated and independent, this independent, both can be used only in standard deviation. Standard deviation alone there is an impact. Expected cash flow there is no impact. Okay, so this becomes 82,000, 1 lakh, 98,000, 98,000, 1 lakh 7,000, 1 lakh 7,000 and 1 lakh 12,000. So all expected cash flow I know. Now what I have to do? I have to do the present value to calculate the NPV. So present value is 0.909, 0.826, 0.751, 0.683, 0.621, and then 0.564. So multiply, I will get 74,538, 82,600, 73,598, 66,934, 66,447, and 63,168. So what is my discounted cash inflows total? 4,27,285 minus discounted cash outflows. What is the discounted cash outflow? 4 lakhs. So which means 4 lakhs. So this is what is the expected NPV. So basically what is happening here, sir? NPV I know. What is the expected NPV? NPV for expected cash flow is equal to expected NPV. But expected cash flow, I'm just adding both this. Why, sir? This separately they have given. This separately impact will come in standard deviation, you will understand. But for now, sir, expected NPV is 27,285. This is what is the expected NPV. Clarity, Rika? So now, sir, now I want to calculate. This is what is expected NPV. Okay, calculation of expected NPV. Now I have to calculate the standard deviation of expected cash flows. This is NPV of expected cash flows. Now I have to calculate standard deviation. I already told you in notes that to calculate the standard deviation, if it is perfectly correlated, then present value of standard deviation is this, okay? Present value of the standard deviation is the thing. So basically, if you see the question, he is giving standard deviation. So the present value of the standard deviation is nothing but the standard deviation of expected cash flows. Okay, standard deviation of expected cash flow. So for perfectly correlated components, so for perfectly correlated components, what I should do? For perfectly correlated components, it is nothing but year and then standard deviation. So 1, 2, 3, 4, 5, 6. So I have to take 4,400, 4,500, 4,400, 4,500, 3,000, 3,200, 4,000, and then 4,000. I have to do the present value factor at the rate 10%, and then I have to do the present value. So this present value is the standard deviation. This present value is the standard deviation. So 0.909, again 0.909, 0.826, 0.751, 0.683, 0.621, and then 0.564. So if I multiply, I will get 3,999.6, 3,717.0, 2,253. See, I'm just doing for your calculation. 2185, 2484, and then 2256. So if I total this, I will get 16,895.2. 2185.6. Okay, so this is nothing but the standard deviation, 16,895.2. This is the standard deviation of the perfectly correlated components. Sir, for independent component, independent component means what? Okay, independent component means they are not perfectly correlated. Okay, they are not perfectly correlated. So how you have to do? First you have to calculate the present value of the standard deviation, then you have to do the square. So basically what you have to do for independent components, that is a separate thing. For independent components, so this is a very interesting question. In the same question both the components have been asked. Okay, so year and then standard deviation. So now this value you have to take 4000, 4400, 4800. Okay, so 1 2 3 4 5 6. So 4000, 4400, 4800, 4000, 4000, and then 3600. Sir, present value factor at the rate 10%. Okay, present value factor at the rate 10%. Sir, same thing only you're doing. No, same thing I'm not doing. Just see what I'm doing now. 0.909, 0.826, 0.751, 0.683, 0.621, and then 0.564. Then what is this, sir? This is nothing but present value of standard deviation. Okay, so present value of standard deviation. So 36.0, 3634.4, 3604.8, 2732.0, 2484.0, 2030.4. Now what next, sir? The next one is I have to do the square. Sir, yes. So present value of standard deviation square. So okay, very big number. So I will just do the square and then I will do the sum. Okay, I will do the sum. So this sum, if I do the square root, I will get the variance. Okay, this sum, if I do the square root, I will get the variance. So what I'm getting? 5 crore 71 lakh 80,546. Okay, this is what is the variance. Sir, but here what is the variance, sir? Here the variance is 16895.2 into 12, which is coming to how much? 16895 into 16895. Wait, 16895.2, 16895.2. 28 crores 54 lakhs 47,783. Sir, but this is the variance. Wait. Okay, sir, now what is the variance of the project, sir? Variance of project is equal to variance of perfectly correlated cash flow plus variance of independent not perfectly correlated. Okay, independent cash flows, which is nothing but 28.54 crores plus 5.72 crores. Okay, so 28.54 plus 5.72 is equal to 34.26 crores. Okay, but I want to calculate the standard deviation. So what I have to do? I just have to do the square root. So the answer is 5.85 crores. Okay. No. Wait. 28 crore 54 lakh 47,783 plus 5 crore 71 lakh 80,546, 18,510. Okay, don't do it in one more mistake. A lot of people will do 34.26 up here, you will do square root. This is wrong. Okay, this is wrong. Square root you should not do. You have to write the full numbers. Once you write the full numbers and then if you do the square root, you will get 18,510. Sir, what is the total of full numbers? Okay, 28 crore 54 lakh 47,783 plus 5 crore 71 lakh 80,546. So the answer is 34 crore 26 lakh 28,329. Do the square root, you will get 18,510. So this is what is the standard deviation of the project. This is what is the answer that they are looking for. Are you all with me? So this is how you have to solve the problem. Next one, what? Also find the probability that the project will be successful. That is for an NPV of positive. And state the assumptions under which the probability can be defined. See, I want to find out the probability for NPV more than 0. Okay, NPV more than 0. Basically, this is a normal distribution. So if the normal distribution table you have to take, and from there you have to solve. Okay, what the Z value, the Z score you have to calculate. So basically, how you have to handle this? Okay, how you have to handle this is that 18,510 and expected NPV is 27,485, mean and standard deviation. Okay, so the probability of Z should be more than or equal to, Z should be more than or equal to NPV. It should be more than or equal to 27,285. Okay, so 27,285. Why it should be more than 27,285? Because 0 minus, I just have to do 0 minus because it is asking more than 0. So 0 minus divided by, for a standard deviation of 18,510. Okay, so which is nothing but P into Z should be more than or equal to 27,285 divided by 18,510. You will get 1.474. Okay, 1.474. So from the natural log table you have to calculate the Z value and then you will get the probability. Mostly this question is not asked, even though if it is asked, key and notes they will be given, because table they will not give, but in the notes they will give. Okay, in the notes they will give distribution of mean, you have to see. So this is a normally distributed table. So this is how the problem will be asked. Mostly this will not be asked in the examination. Okay, mostly this will not be asked in the examination. Even if it is asked, normal table should be given. Are you all with me? Now for risk analysis, one last problem. Okay, for risk analysis, okay, this is not risk analysis, this is leasing. So risk analysis is completed from here. So now next two questions are from the leasing. With that we will complete the first part of our discussion. Okay, first part of our discussion. Are you all with me? So first part. Super. Sir, the firm has the choice of buying a piece of equipment at a cost of rupees 1 lakh with borrowed funds, okay, at a cost of 18% per annum, repayable in 5 equal installments of 32,000. 5 equal installments of 32,000. Wait, cost of 1 lakh. 32,000 into 5 is coming to 1,60,000. Or to take on lease the same on an annual rental of 32,000. The firm is in the tax bracket of 40%. Okay, the firm is in the tax bracket of 40%. Okay, the firm is in the tax bracket of 40%. If the cost is 1 lakh and I'm repaying it in 5 annual installments, correct, 32,000 plus 32,000 plus, okay, this is including interest, probably this is including interest. Okay, The firm is in the tax bracket. The salvage value of the equipment at the end of the period is 0. The firm uses straight line method of depreciation. Sir, first one, whenever leasing problem is asked. Okay, let us go to the leasing notes to spending, right? See, only two types of questions are possible. One is buy or lease, or second is break even lease. Two problems are there. Okay, both the problem we have done in the my T50. Okay, we will be covering. Sir, buy or lease, whether to buy or whether to lease, calculate the present value of buy, calculate the present value of lease. Wherever the present value is lower, select. Simple. Sir, what is present value of lease? Whatever is the lease rental that you are paying, do the discounted and get it into present value. That is after tax, because whenever you are paying lease, you will get a tax benefit. So after tax lease rental, you present value. That is what is the present value of lease. Sir, what is present value of buy? 0th year, what is the payment that you are making? Correct. Every year, what is the depreciation that you are getting? What is the cost that you are spending? Everything you have to consider, and then you have to calculate NPV of buy. You check whether the NPV of buy is more or NPV of lease is more. If the NPV of buy is more, so lease it. NPV of lease is more, buy it. Simple. Okay. In buy, mostly loan will be taken. So loan will be taken, and we have to calculate something called as loan schedule. And in loan schedule, how to calculate installment amount? This is loan amount divided by present value annuity factor. Okay, loan amount divided by present value annuity factor. So using loan schedule, you will bifurcate the principal portion and interest portion. So on the interest portion, you will get tax benefit. Sir, why you are calculating loan schedule? Because I want to bifurcate it into principal portion and then the interest portion. So interest portion alone, I have to have some tax benefit. Again, what's a depreciation portion? I will get a tax benefit. These two tax benefit I will get. Okay, these two tax benefit I will get. What is the loan, sir? Present value of installments plus present value of tax benefit on interest plus present value of tax benefit on depreciation. That is what is the loan cash flow NPV, and minus, okay, no doubt to say, this is what is the discounted cash flow, loan cash flow. So sir, this is what is the problem. Sir, what is break even lease rental? At what lease both the option will be equal? So take lease rent as 0 and solve it. Simple problem it is. Okay, take the lease rental as 0 and equate it, you will get the answer. Okay, so let us just solve for question number 10. See, very simple. Okay, very simple. All the problems are very simple. Question number 10. Solution to question number 10. Okay, now a firm has the choice of buying a piece of equipment. Okay, we have read the question. So first we will do present value of leasing. First, present value of lease option. Sir, what is present value of lease option? It is nothing but lease rental. So lease rental is my outflow. On this outflow, I will save some tax. So after tax lease rental into present value annuity factor. That's it. Sir, what is my lease rental? 32,000. Okay, my lease rental is 32,000. My lease rental is 32,000. Sir, what is my tax rate, sir? My tax rate is 40%. So 1 minus 40% into what is my present value annuity factor? Sir, whenever lease rental is given, now what you have to do? Which discounting rate you will take? Okay, which discounting rate you will take? That is something that you have to see now. See, first one, 18% is a loan amount. So what is the after tax loan? 18% minus 40% is equal to 10.8%, but here 11 is given, right? So you have to take it as 11%. So actually your discounting rate is nothing but 11%. Because why, sir? Because when we are taking a loan, okay, because when we are taking a loan, what is happening? Whenever you are taking a loan, then you will be getting at a discounting, you will be spending something. But whenever you are paying interest, the interest rate is 18%, but the discounting rate, okay, but the discounting rate is nothing but after tax rate. So 18% into 1 minus t, which is nothing but 18 percentage into 1 minus 40 percentage is equal to 10.8 percentage. If it is not given, take closest 11 percentage. Okay, super. So this is what is the discounting rate, 11 percentage. So what I have to do, sir? I have to take the total of 11 percentage. So please do total everything, because that is what is the present value annuity factor, correct? That is what is the present value annuity factor. 0.901 plus 0.812 plus 0.731 plus 0.659 plus 0.593, 3.696, sir, into 3.696. So 3.696. So sir, 32,000 minus 40 percentage, 32,000 minus 40 percentage multiplied by 3.696. My present value is equal to 70,963. Now what is the present value of buy option? Okay, what is the present value of buy option? Very simple. Present value of buy option is nothing but initial cash flow, like that you have to do. Okay, sir, first, whenever you are purchasing, you just see what is the outflow and what is the benefit that you are getting. Okay, what is the benefit that you are getting? Sir, your outflow is every year 32,000 installment you will pay, and benefit is tax benefit on interest and tax benefit on depreciation. So first you have to calculate something called as interest schedule, then you have to calculate something called as depreciation schedule. Okay, depreciation straight line. So first you have to calculate interest schedule and then depreciation schedule. Sir, first schedule of interest, or we will also call it as loan schedule. Always loan schedule is year opening balance, interest, principal repayment, installment, and then closing balance. Always remember this. This loan can be used, this loan schedule can be used anywhere. Sir, how much years? 5 years, sir. 5 equal installments. Okay, so 5 years. So 1, 2, 3, 4 and 5. See here, installment amount is directly given 32,000. So I will put 32,000 here. Interest is at the rate what percentage? 18 percentage. Basically, what is my opening balance of loan? 1 lakh rupees. Okay, so 1 lakh rupees. On 1 lakh, how much interest I will pay? 18,000 interest I will pay, correct? Now, but I have paid how much? 32,000. So 32,000 la 14,000 is the principal repayment. So what is my closing balance? 1 lakh minus 14,000. 86,000 is my closing balance. Usually installment amount we will only calculate. Okay, usually installment amount we will only calculate. But here installment amount itself they have given. So how to calculate installment amount? Loan amount by EMI. EMI, loan amount by present value annuity factor. Okay, loan amount by present value annuity factor. Basically, that is what is the installment amount. But here they have directly given. Sir, now 86,000. Sir, what is the interest on 86,000 into 18 percentage? 15,480. 15,480. But how much we have paid? 32,000. So what is the principal repayment out of that? 16,520. So 16,520 reduced from 86,000, what are you getting? 69,480. So now 69,480 into 18 percentage. It is nothing but 12,506. should have been the interest, but how much we have paid? 32,000. So how much goes against principal repayment? 19,494. Okay, 19,494 plus 69,480. So it is 49,986. So now 49,986 into 18 percentage. Your interest is 8,998. Okay, 8,988. But how much you have paid? 32,000. So this comes to 23,002. So out of 49,986, you have paid 23,002. Wait. 23,002 is the principal repayment. Yeah, 49,986 minus 23,002. You will get 26. Wait. 26,984. So 26,984 into 18 percentage is 4,857. But actually, how much I have paid? 4,857. How much I have paid? 32,000 I have paid. So that comes to principal repayment comes to 27,142. So your principal repayment, actually this should become 0. So this is 26,000 approximately, you just keep okay, some rounding off. So this should come to 0. Okay, this should come to 0. So that is what, sir, what is the main important part here? Interest is the important part. You have bifurcated the principal into interest. Sir, why you are calculating interest? Because I will get tax benefit on interest. Clarity. Now there is also something called as depreciation schedule. See, if the examiner is a sadist person like me, he would have done WDV depreciation. Because it is straight line depreciation, this becomes very easy. 1 lakh divided by 5, 20,000 is a depreciation. Very simple. 20,000 is a depreciation. Clarity. So tax benefit on depreciation also I will get, tax benefit on interest also I will get. So what I can do directly, I can do interest plus depreciation into tax rate is a tax benefit on interest. This much clarity you are having. Okay, sir. Sir, now what I can do here is that I can calculate cash flow, which is nothing but the principal repayment. What is my cash outflow? Principal repayment. Okay. So here principal. So 1, 2, 3, 4, 5, 6. Sorry, not principal repayment. Loan repayment. Okay. Loan repayment. Every year I'm paying 32,000 because that is my cash flow, right? 32,000. Now on this 32,000, interest and depreciation, I will get some tax benefit. So what I should do now? Interest and depreciation and interest plus depreciation into tax rate. This I have to reduce to get my cash flow after taxes. Clarity. Sir, how much is my interest? You already know, 18,000. Or directly can I put interest plus depreciation into tax rate, or wait? Or I can calculate something called as tax shield on interest and depreciation. This thing I can do. Okay, tax shield on interest and depreciation. Okay, let me do this directly. Present value of tax shield on interest on depreciation. How much is the depreciation every year? 20,000. Sorry, not 20,000. 1 lakh by 6, right? 16,006. No. 5 years, right? Not 6 years. It is 5 years. Sorry. So 20,000. 20,000. 20,000. 20,000. 20,000. 20,000. Sir, how much is my interest? 18,000. 15,480. Okay, 15,480. 12,500. 506, 8,998 and 4,857. Sir, interest plus depreciation into tax rate is nothing but tax savings on depreciation and interest, because on this both I will get tax savings, right? So how much is the tax rate? 50 percentage? Or 40 percentage is the tax rate. So now what I have to do? 20,000 plus 18,000 into 40 percentage. Sorry. 20,000 plus 18,000 into 40 percentage. I will get 15,200. Okay, 15,200. Likewise, 14,192, 13,002, 11,600, and then 9,943. Okay, 9,943, and then present value factor I will do at 11 percentage, right? At 11 percentage, 0.901, 0.812. Okay, 0.901, 0.812, 0.731, 0.659, and then 0.593, and then discounted cash flows, or so 15,200 into 0.901. Okay, it is nothing but 13,695.2. 14,192 multiplied by 0.812, it is nothing but 11,523.9. Okay, now 13,002 multiplied by 0.731, it is equal to 9,504. Sir, next one, 11,600 multiplied by 0.659, 7,644.4. Okay, then next one, 9,943 multiplied by 0.593, it is 5,896.2. What is the total? 13, 24, 33, 39, 48. 13,695.2 plus 11,523. 13,695.2 plus 11,523.91 plus 9,504 plus 7,644.4 plus 5,896.2. You will get 48,264. This is what is present value of tax shield. Okay, present value of tax shield on interest and depreciation. This much clarity you are having. Sir, what is NPV of buy, sir? NPV of buy is nothing but first one, what is the cash outflow? Okay, what is the cash outflow? Okay, what is the cash outflow? The cash outflow is first one, present value of loan repayment. That is one outflow. Minus, you are getting an inflow, present value of tax shield on interest and depreciation. Sir, what is my present value of loan repayment? So present value of loan repayment 32,000, right? So 32,000 into present value annuity factor. What is my present value annuity factor? 3.696. 3.696 minus 48,264. Okay, so 32,000 into 3.696, it is nothing but 1,18,272 minus 48,264 minus 48,264 is equal to 70,000, which means, sir, my present value of lease option is 70,963 and buy option is 70,000. Since NPV of buy is less, which is nothing but cash outflow, because it is an outflow is right, so outflow is less, it is advisable to buy using borrowed funds. Are you all with me? Because this is the present value, correct? So present value of buy and present value of lease. Sometimes we can also solve it using incremental approach. So incremental approach is nothing but you will do present value of lease option, you will just reduce it here, okay? So in the outflow you will just reduce the present value of lease and then you will get that answer. But this is the most preferred answer, okay? This is the most preferred answer. You should also write buy. Buy how much? 963 rupees, okay? Buy 963 rupees, okay? So with this, question number 10 is also completed. Now let us jump on to question number 11. Sir, question number 11. Okay, let us read the problem first. Okay, let us read the problem first. Question number 11. S Limited is faced with a decision to purchase or acquire on lease a mini car. The cost of the mini car is 1,26,965. Cost. It has a life of 5 years. The mini car can be obtained on lease by paying equal lease rentals annually. The leasing company desires a return of 10% on gross value of the asset. Okay, on gross, the leasing company wants 10% on the value of the asset. So basically this is the return that they're expecting. So that is the discounting rate you have to use for leasing. S Limited can also obtain 100% finance from its regular banking channel. The rate of interest will be 15% per annum and the loan will be paid in 5 equal installments. So 5 equal installments inclusive of interest. So it means EMI. Okay, EMI. So how much is the EMI? Now itself you can calculate. Okay, now itself you can calculate. This 15% total first you have to do. Okay, this 15% total first you have to do. 0.87 plus 0.76 plus 0.66 plus 0.57 plus 0.49, 3.35. Okay, so EMI is nothing but 1,26,965 by 3.35. Okay, so 1,26,965 by 3.35 is this equal to 37,900 rupees. Okay, so EMI is equal to 1,26,965 divided by 3.35, it is equal to 37,900, or it is also called as loan repayment. Instead of EMI you just write loan repayment per annum. Okay, simple. The effective tax rate of the company is 40%. For the purpose of taxation, it is assumed that the asset will be written off over a period of 5 years on a straight line basis. Advice estimated about the method of acquiring the car. Okay, about the acquiring of car. See, first one. Okay, first one, what you have to do. Okay, first one, what you have to do. First, you have to calculate something called as loan schedule. Straight line method only, right? Nothing is given. Nothing is given. Take straight line method. Okay, nothing is given, then take straight line method. Okay, sir. But one point that you should never forget here is that estimate can also obtain 100% from its regular banking channel. The rate of interest will be 5% per annum and the loan will be paid in 5 annual equal installments inclusive of interest. The effective tax rate of the company is 40%. For the purpose of taxation, it is assumed that the asset will be written off on a straight line basis. Advise, what should be the annual lease rental to be charged by the leasing company to match the loan option? Okay, to match the loan option. Now this is what is the problem which is given to you. Okay, this is what is the problem which is given to you. See, usually sometimes they will give that first installment is paid today or first installment is paid after 1 year. Nothing is given. If the questioner, okay, if the examiner is a sadist person like me, now what he will do, he will write a sentence, first installment is paid today itself. So likewise your loan schedule will also change. Okay, likewise your loan schedule will also change. So basically now what you have to do, so now you first thing you have to do is that calculation of loan schedule. Whenever question comes, first calculation of loan schedule. Okay, calculation of loan schedule. Sir, here opening balance, interest, okay, principal repayment, installment, and then closing balance. 5 years, correct? So 1 2 3 4 and 5. How much is my opening balance? 1 lakh 26,965. 1 lakh 26,965. What is my interest percentage? 15%. Okay, interest at the rate 15%. Okay, so interest is at the rate 15%. So 126,965 into 15% is nothing but 0.87 plus 0.76 plus 0.66 plus 0.57 plus 0.49 is 3.35. They are assuming that the loan is repaid at the beginning of the year. Why this assumption is taken? Like actually the answer, this is taken from the workbook. In your workbook, they are assuming that the loan is taken at the beginning of the year. But if nothing is given, you don't have to take that assumption at all. Okay. If nothing is given, don't take any assumptions. So first you have to calculate the loan schedules. So 126,965 into 15%. That comes out to 19,045. Are you all with me? So likewise, this is what is something that I want you to do. Okay, this I want you to do. So calculate the interest for all the 5 years. Okay, calculate the interest. Come on. Or you want me to do see what is the installment amount? 37,900. 37,900, 37,900, 37,900, 37,900, and then 37,900. Okay, minus 37,900. Your principal repayment is nothing but 18,855. 126,965. So how much is the closing balance? 1,08,110. So 1,08,110 multiply by 15%. Again you will get 16,216. Then what is your principal repayment? What is your installment? 37,900. So basically what goes to your principal repayment? 21,684. That goes, which means what is your closing balance? 108,110. Your closing balance comes to 86,426. So 86,426 multiplied by 15% comes to 12,964 But what is your repayment? Your repayment is 37,900. So what goes towards principal repayment? 24,936. If 24,000 goes towards your loan repayment, what is your closing balance? 86,426. That comes to 61,490. So 61,490 into 15% is how much? 9,223. If this is the interest, but how much you have paid? You have paid 37,900. So what goes towards the loan repayment? 28,677. Which means what is your closing balance? 61,490. Your closing balance comes to 32,813. So 32,813, multiply that with 15%, you will get 4,922. And how much you are paying? 37,900. So principal repayment is nothing but 32,979. Basically this should become 0. Okay, so you adjust a principal amount with that respect. So this 100 rupees is just because of discounting rate rounding off. So this is what is your interest. Clarity? So this is what is your interest. Now once you know your interest, and then you know your depreciation also. Once you know your interest and then you know your depreciation also. Sir, how much is the depreciation? Depreciation is 1,26,965 divided by 5. Okay, so 126,965 divided by 5 is equal to 25,393. So interest you know, depreciation you know, then you have to calculate something called as present value of tax shield on interest and depreciation. Once you know that, okay, once you know that, then you can calculate the NPV of buying. Okay, you can calculate the NPV of buying. Once the NPV of buying is done, then you should also know what is the NPV of leasing. So lease rent is not given, but he is telling that I want 10%, correct? I want 10% return. So what is my lease rental? My lease rental would be 126,965 plus this, okay, 10%. So 0.91 plus 0.83 plus 0.75 plus 0.68 plus 0.62. That comes to 3.79, correct? .91 plus 0.83 plus 0.75 plus 0.68 plus 0.62 is 3.79. Okay, so first I will calculate the NPV for buying option. Okay, NPV for buying. Interest you know, depreciation you know. Please do interest plus depreciation and calculate the present value. Okay, so what is the NPV for buying? NPV of buying is equal to present value of loan repayment minus present value of tax shield on interest and depreciation. Okay, this thing you calculate, this thing you calculate, this thing I will calculate. Now what is the present value of loan repayment? It is nothing but 37,900. okay, 37,900 multiplied by present value annuity factor at 15%. Okay, but 15% is the rate of interest. Then what you have to do? 15 minus what is the tax rate? 40%, which is coming to 9%. So basically you have to discount it at 9%. Are you all with me? See, all the three discounting rates you are using. Very interesting problem, right? 0.92 plus 0.84 plus 0.77 plus 0.71 plus 0.65. So 3.89 3.89. So basically into 3.89 into 3.89 minus you do okay, what is the tax shield on depreciation? You will get the NPV for buying. Clarity. Sir, what is the NPV for leasing? Present value of lease basically. Present value for leasing. It is nothing but lease rental into 1 minus T into present value annuity factor. Again, you have to do for 3.89 only, okay, 9%. Why, sir? Leasing, see, both the NPV, this different discounting rate, how we can compare. So basically, we are seeing from the standpoint of the lessor, whether I should purchase or whether I should lease. Sir, how much is my lease rental? Lease rental itself, he is telling that 1,26,965. Okay, 1,26,965 divided by present value annuity factor of 10%. He want 10%, so 3.79 divided by 3.79. 3.79. So how much is the lease rental? 1,26,965 divided by 3.79. My lease rental is 33,500. Okay, this is nothing but 33,500. Okay, lease rental is 33,000. So 33,500 into 1 minus 40% multiplied by 3.89. Okay, so 33,500 minus 40% into 3.89 is equal to 78,189. So 78,189 is the present value of leases. Okay, is the present value of leases. Now you have to calculate what is the present value of this buying. One more thing, there is one more variation in this question. They will tell that the payment starts from 0th year. Suppose if the payment starts from 0th year, cash flow will be 0 to 5. So 0 to 4. 0, 1, 2, 3, 4. These 5 payments will be 0 to 4. Then what will be the discounted rate that you will take? 1 plus 1, 2, 3, 4. That would be the discounting rate that you will take. Plus the tax benefit you will get in 1 to 5. In a payment when you are making, advance payment that you are making, but tax benefit you will get in the next year only. So basically that is one adjustment that you have to do. So that is one more variation of problem that could be asked here. Okay, in your textbook it is solved wrongly. Variation itself wrong and this question itself wrong. Okay, so they have solved wrongly, but this is how you have to solve this problem. Are you all with me? So present value of leasing is 78,189. You please calculate and tell me what is the present value of tax shield on interest and depreciation. Once you calculate that, you will get the NPV for buying. Once you do the NPV for buying, you will get to know. Okay, you will get to know what is this. But next set of question is calculation of break-even lease. Okay, calculation of break-even lease. But for break-even lease, you should know what is the NPV for buying. Okay, so let me calculate what is the present value. Okay, what is the present value of tax shield on interest and depreciation. See, I'm spending so much of time such that you guys are understanding this. Here, interest, depreciation, interest plus depreciation into 40%, present value factor at what rate? At 9%. Okay, 3.89%. Okay, at 9%, and then discounted cash flow. Okay, so 1, 2, 3, 4 and 5. So 19,045 plus 25,393. Okay, plus 25,393 into 40%. I'm directly writing this amount 17,775. Understanding this is what is the tax shield on interest and depreciation. Okay, tax shield on interest and depreciation. So next one. Next, what is the interest? 16,216 plus 25,393 into 40 percentage. Sir, it is 16,644. Next one, 12,964 plus 25,393 into 40 percentage. 15,343. So next one, 9,223 plus 25,393 into 40 percentage. 138. 13,846. 13,846. Sir, fifth one, 4922 plus 4922 plus 25,393 into 40 percentage, 12,126. Okay, 12,126. Now present value at the rate 9 percentage, 0.92, 0.84, 0.92, 0.84, 0.77, 0.71 and then 0.65. Now I just have to multiply 17,775 into 0.92, 16,353, 16,644 into 0.84 and side by side plus m plus also 13,981, 15,343 into 0.77, 11,814, 13,846 into 0.71, 9,831, 12,126 into 0.65, 7,882. So what is my total? 59,861. So 59,861. So 37,900 into 3.89 minus 59,861 is equal to 87,570. So buying NPV is 87,570, leasing NPV is 78,000. So it is advisable to lease. Okay, it is advisable to lease. Why? Because the cash flow for leasing is less. 78,189 is my cash flow for leasing. Are you all with me? Super. Sir, what is break-even lease? Break-even lease means from the standpoint of lessor. Now I want to see if I am leasing, what I should keep my lease. What I should keep my lease such that buying option is equal to leasing option. So which means present value of buying should be equal to present value of leasing. What should be my lease amount? But what is my present value of buying? 87,570. So 87,570 is equal to some lease amount, keep it as X, into 1 minus 40 percentage into present value annuity factor. Okay, into present value annuity factor. So what is my present value annuity factor? 3.89. 3.89. Calculate that X. It is very simple. Okay, so X is equal to 87,570 divided by, this will come here 3.89. This is 1 minus 40 percentage is 0.6. So this 0.6 will also come here into 0.6. Okay, So 87,570 divided by 3.89 divided by 0.6. So the answer is 37,520. Okay, 37,520. Previously it was 33,500, right? In 33,500 leasing was better. But if you're increasing the lease to 37,000, then leasing and NPV will be same. So more than this lease, NPV will be better. Understanding? So this is what is the answer. This is what is the answer. Now in this, sometimes what they will do, is that my lease is increasing or my lease is in the ratio of 3:2:1. Don't worry, nothing. So 3:2:1, you just put a cash flow here. Okay, cash flow. So here cash flow will be, okay, this will be x, this will be 2x, and this will be 3x. If it is in the ratio of 1:2:3. If it is in the ratio of 3:2:2, then 3x, 2x, 1x. Like that you solve for x, and then you will get the answer. Okay. So simple. This is how problems are asked. So your break-even lease is 37,520. Okay. So with this, we have covered the set A. Okay, we have covered the set A. See, break-even lease rental. From the standpoint of lessor, what should be the minimum lease payment? That should be charged. Minimum lease payment I should charge 37,000. So NPV of buy, you have to calculate this. Present value of lease rental, equate here by keeping the lease rental as x. So present value of lease rental is equal to x into 1 minus t into present value annuity factor. You equate it. So lease rentals can be annuity payment. Lease rental can be in some ratio, or lease rental can be increased or deferred. For example, first year I am not paying any lease. My lease will be starting from second year. Don't worry. Put year cash flow, first year 0 and second year x. Sorry, 1x, 2x. Like that you keep it. Okay, so but you have to solve it in that way. Are you all with me? Nothing, everything is very simple. It is just that more and more problems that you solve, more and more clarity you will get. Are you all with me? So with this, we have completed, okay, we have completed this section A. Okay, this section A, which is nothing but this, okay, securitization, you read it on your own, this. 25% of the portion, basically 30% of the portion is completed using, okay, using this 11 questions. In this 11 comprehensive questions that you have solved, we have covered all the chapters and all the concepts that is possible we have covered, also with the concept notes I have covered. Are you all with me? I hope you all are comfortable. Okay, so now we will be continuing with the next set of sections in the following discussions. Are you all with me? Okay.